Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things you might want to know in the 3 years leading up to retirement, or maybe even the 3 months leading up to retirement, or the 3 weeks leading up to it, because you're going to retire soon and you probably have some questions. Questions like, what do I need to know? And what do I need to do, if anything? So we're going to answer those questions today for you. And I've arranged the presentation in the form of a checklist. So this is your pre-retirement checklist. I'm going to help you understand your membership. We'll talk about your retirement contributions. We'll look at a retirement timeline. We'll talk about your tier. I'm also going to help you estimate your retirement benefit. So I'll tell you about the retirement formula. I'm going to talk about purchasing service credit, considering doing that. I'm going to tell you how vacation sales affect your salary. And I'm going to show you the benefit estimate tool in your account, in your Acera online account. I'm also going to help you verify your retirement eligibility, choose a retirement date. I'm going to show you what the application process looks like in order to retire. We'll talk about the 5 retirement allowance options. And then I'm going to help you understand other benefits like medical, dental, vision benefits. And we'll talk a little bit about life events and signing up for the Acera email news. So let's jump right in and get started. First item on the checklist, understanding your membership. Okay, so who is Acera? In one sense, Acera is this acronym, the Alameda County Employees Retirement Association. But it's made up of a lot of people, okay? So there are about 90 of us that work here. And what we do at Acera is we provide retirement, disability, and death benefits to our members. That's all of you. So you are also part of Acera by being a member of Acera. And the reason you're a member of Acera is because of the position that you work in and who you work for. You work for one of the 6 public employers in Alameda County that participate in Acera. They participate in Acera because their employees are earning a retirement through Acera. And you became an Acera member automatically because of the position that you work in for one of these 6 employers. The position is at either now or at some point in the past, it was full-time and is a retirement eligible position. And that is what made you automatically an Acera member. Let me, my pointer keeps disappearing. Let me change that setting real fast. Okay, I forgot where that setting is. I'll just have to live with it. Okay, so how does Acera work? First of all, here's you. You're the employee and you contribute to Acera's fund. So every time you get paid, a part of your paycheck comes out of your check, goes into Acera's fund. And you can look at your paycheck and see that happen. In the before tax deductions column, you'll see a line that says retirement, and that is your contribution that you're making every paycheck to Acera's fund. And whenever you contribute to the fund, your employer is also contributing to the fund on your behalf. So then we have these 2 sets of contributions. So what do we do with that money? Well, we invest that money all over the world. We don't just want it to sit there and like lose value to inflation. We want it to gain value through interest. And so we have a lot of different diversified investments that we invest your money in and earn interest on those. And so these are the 3 sources of income for Acera's fund, the contributions that you and your employer are making and the interest that we earn on that money. And so that gives us this big pool of money we call Acera's fund. So then what do we do with that money? Well, you are working. And while you are working, you are earning credit toward retirement throughout your career. Okay. Then at some point in the future, you are going to retire. And at that point, that's when you start drawing the benefit that you've been earning throughout your entire career. And when you retire, you're going to get that benefit, also known as your retirement allowance, every month for the rest of your life. You cannot outlive your retirement because it's going to be paid every month on the last business day of the month for the rest of your life. Okay. So that is kind of basically how Acera works. Now, let me show you this set of pension milestones. This is kind of a high-level view of some of the different milestones you can expect from your Acera membership. The first milestone is your date of hire. So this is your first day of work in your full-time retirement eligible position. If you started out in that full-time retirement eligible position, then this would be probably the day that they first told you to show up to work. Now, if you started out working part-time, this date of hire, we would consider it the day that your first day of work in that full-time retirement eligible position. Okay, then 2 weeks goes by for most members. And the first day of your second pay period is actually your first day of membership into Acera, also known as your date of entry. I think maybe the housing authority is the exception to that. And there may be one other employer where your actual date of hire is your first day of Acera membership. If you look at the pension milestones page on our website, it will tell you that. Okay, so we know what your first date of Acera membership is. This is the day that you start earning credit toward retirement. Then 5 years goes by. After 5 years, you're considered vested in the retirement system. And vested and vesting, it just means guaranteed. Okay. So when you're vested, you're guaranteed the vested benefits. You're guaranteed the guaranteed benefits. So built into the system are these guaranteed benefits. And once you achieve vesting status, that's when you're guaranteed the guaranteed benefits. That's what that means. Okay, then some other indeterminate amount of time goes by and you become eligible to retire. And it's going to be different for everyone based on your situation because it has to do with your years of service credit and your age. And there's some combination of those that get you to retirement eligibility. And we'll talk about that in the middle of the presentation. Okay, so now you're eligible to retire. So you can retire immediately on that day, or you can work more and earn more credit toward retirement. So at the next milestone is your retirement date, and it's going to be a date that you choose. This is the day that you stop earning credit toward retirement and start collecting your retirement. And you're going to collect that every month for the rest of your life until your death. And that's when your retirement payments to you stop because you're not around anymore to collect them. And that's built into the system. Now, there's one more pension milestone here. Some of the retirement options that you will choose at the time of retirement allow for a continuing payment to a beneficiary that you name at the time of retirement. And so in many scenarios, that continuing payment will continue, also known as a continuance, will continue until your beneficiary's death. And so that's why that is a milestone on here. We'll talk about each one of the items, each one of these milestones in more detail as we go through the presentation. Okay, at this point, I want to introduce you to the retirement worksheet. In the email that you received, there was, I think, a link to this worksheet. And if you didn't receive the email, the way to find the worksheet is to go out to our website and you go over to the news and events section, come down to retirement planning seminars where you enrolled in the seminar, and you just scroll down to pre-retirement webinar. And there's a link here for the worksheet, and it's a PDF. You can download it and print it out and fill it out by hand, or it's fillable, so you could just save it on your drive and fill it out. And this is kind of your takeaway from the seminar, because it's a 3-hour seminar. There's a lot of information that I throw at you. This is your opportunity to write down what your specific numbers are that you learn as we go through the seminar. So when you come back, maybe like in a few weeks or a few months or a few years, and you try to remember what you learned in the seminar, you can pull out this worksheet and go, oh, okay, now I remember what tier I'm in. I remember what my Acera entry date is, and so on and so forth. Okay. So at this point, we're going to look at this My Career Timeline section of the worksheet. And let me switch back to the presentation here. Since now we know what your ACERA entry date is, it's the first day of your second pay period, you can go ahead and put that in at this point. Now, this isn't super important to get this right. I've written approximate dates up here. Most people are gonna have way more credit than they need to be eligible to retire. And so you don't have to, if you don't remember what the exact entry date is, you don't have to put it in here. If you know it was like November of 2001, you can write that in here. So you don't have to get exact. If you do want to know your exact entry date, though, you can log into your ACERA account and it'll say it in there. Okay. Now, at this point, if you want to, you could, if you have an idea of what your projected retirement date is going to be, you could pencil it in here. But you may learn something during the presentation that may make you want to adjust what that date is. Okay. So just really quickly about vesting. Vesting, like I said, it happens when you have 5 years of service credit, and that includes reciprocal service credit if you have reciprocity with a different California retirement system. And then the guarantee is guaranteed by state law. State law tells us how to run the whole retirement system. Okay. And so that's where the guarantee comes in. And the vested benefits are that lifetime monthly retirement allowance once you retire, an annual cost of living adjustment to that retirement allowance, which is a percentage increase every year to your retirement allowance, and a $1,000 lump sum death benefit. Now, there are other death benefits that we'll talk about later that go with the different retirement options. This is kind of like the basic vested lump sum death benefit. So since you know what your vesting date is, you just take your ACERA entry date and add 5 years. You can write that in there at this point if you want. The vesting date isn't super critical to get exactly right. You just need to know that you're vested, and because you can't retire before you're vested. Let's talk about tiers. You all are in one of these tiers. If you're a safety member, you might have 2 tiers. You might have some a general tier for some general work you did, and your safety tier. Okay, so the way to find yourself on these timelines is, first of all, you need to know if you're a general or safety member. Safety members are sheriff's deputies and probation officers and perhaps other sworn officers. And if you're a safety member, you usually know it. So if you're a safety member, you can look at this timeline at the bottom. Now, everyone else is a general member, except the general members in Housing Authority and Livermore Area Recreation and Parks District will want to look at their specific timeline for their employer. And everyone else who's a general member just looks at the top timeline. Okay, now the way the tiers work is you're in whichever tier you're in because of your date of entry into ACERA. So your date of entry puts you in a particular tier. If you entered ACERA and as a general member, let's say that you work for Alameda County and you're a general member, you entered ACERA on or before June 30th, 1983, that puts you in tier 1. If you entered ACERA July 1st, 1983, all the way up to December 31st, 2012, that puts you in tier 2. If you entered ACERA January 1st, 2013 and beyond, that puts you in tier 4. So that's the way each one of these timelines work. Now, the Housing Authority and LARPD have different cutoffs for the different tiers. LARPD has tier 3 instead of tier 2. And one more thing I want to point out is for the safety members. If you entered ACERA October 17th, 2010, all the way up to December 31st, 2012, you're either in tier 2C or tier 2D, and you had to make a selection within 45 days of entering your safety membership. And if you didn't make a selection, I think you were put into the lower tier, which I think is tier 2C. Otherwise, you chose which tier you're in. Okay, so that's how you know which tier you're in based on this chart. But really, the really definitive way to know is to log into your ACERA account, and when you pull up that first page, it'll say which tier you're in. Okay. Since now you know which tier you're in, you can go ahead and mark that on your retirement planning worksheet. And if you're a safety member, you could either fill out one worksheet, because if you have some general membership and some safety membership, you could do both on one worksheet, or you could fill out 2 different worksheets. Next item in the checklist, let's talk about estimating your retirement benefit. The first thing that I'm going to do is give you a little primer on pension math and how we calculate your retirement benefit when you go to retire. When you go to retire, you are going to receive in retirement as your monthly retirement allowance, you're going to receive a percentage of your highest working salary that you were making while you were working. You're going to get a percentage of that salary for each year of service that you worked in your job. And each year, it's basically each year of service credit that you earned in a SERA. Okay. So let me break it down for you in that sentence down for you in the form of this formula. So we have three factors in the formula. Okay. So let's say the percent of your highest salary that you're going to get for each year of service is 2%. And let's say that you earned 20 years of service credit by working full-time for 20 years in your job. Now, the percent of your highest salary that you're going to get is going to be 2% of your salary for each one of those 20 years. So because it's 2% of your salary for each one of the 20 years, we multiply them together. That means you're going to get 40% of your working salary as your retirement allowance. Now, let's say that your highest average monthly salary is $5,000 to pick a nice round number. So it's $5,000 per month while you were working is basically what you were making. Your retirement allowance is going to be 40% of that. And so we multiply 5,000 by 40%. Your retirement allowance is $2,000. Okay, that's how that works. Let me tell you about each one of those three factors in the retirement formula in a little more detail. So the first factor, the age factor percentage, how do we know what age factor percentage to put in the formula for you? Because there's a bunch of different ones we could put in. Well, it's based on your age at retirement and your tier. So each tier has its own set of age factors that go along with each retirement age. So to find yourself on this sample age factor chart, first you would look at the safety half or the general half based on whether you're a safety member or a general member. Okay. And then you find your tier. And then you forget about all of the other numbers. You just look at that one column. So I'm going to take general tier 4 as an example because a lot of new employees are in general tier 4. When you go to retire, let's say that you're going to retire as a general tier 4 member at age 65. We're going to come out to this chart and we're going to go general tier 4. We're going to go down to age 65, 2.30%. That 2.30% is the percentage of your highest salary that you're going to get for each year of service. So that would be what we put in the formula for you. And you'll note that the percentages get higher the older you are when you retire. So this is kind of one way that you're earning credit toward retirement is simply by getting older. The older you are when you retire, the higher the percentage of your salary you're going to get for each year of service credit. Okay. You'll also note that there is a maximum percentage for each tier, and that is denoted by the blue box in each column. So for example, general tier 2 members can receive 2.43% of their highest salary for each year of service if they retire at age 65. And that's the maximum percentage they can get, because if they retire at age 66 or 67 or 77, they still get that 2.43%. So the percentage stops going up after you reach a certain age. Then you've maxed out the age factor percentage for your tier. Okay. The last thing I want to point out about this chart is that I skipped a bunch of the ages because there are so many they don't fit on the chart. And that's because the percentages actually increase every 3 months that you don't retire. So every 3 months you get a quarter of a year older. There's actually a slight age factor increase for each one of those quarter years. And so if this were the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, 53 and a quarter, and so on and so forth. If you want to see the full set of all of the age factor percentages, you can find that by going to acera.org/age, or you can just search for the age factor percentage chart in the search blank. And it's a PDF and it has every single age factor. Okay, that's the last thing I needed to say about age factor percentages. Now let's talk about years of service credit, the second factor in the retirement formula. Because people, it's good for you to know like how you earn service credit, when you're earning it, when you're not earning it. Okay. So first of all, you start earning service credit toward retirement, like I said earlier, on your date of entry into ACERA. That is your first day of ACERA membership and the first day you earn service credit. And you're going to earn service credit all the way up if you go straight into retirement to your retirement date. And technically, it's going to be the day before your retirement, which is your date of termination. That's the last day that you earn service credit. But this is basically the time period that you're earning service credit. Now, for those of you who are not going to go straight into retirement, you're going to terminate earlier and defer your retirement to a later date. Then there would be an extra milestone here that would say termination date, and that's when you would stop earning service credit. Okay. Now, you earn service credit during your regular work hours, obviously, but you also earn service credit during earned leave times, such as vacation leave, sick leave, management leave, comp time, holidays, floating holidays. You already earn service credit during those. Those don't count against you for retirement. So you don't have to worry about whether you're earning service credit during that time. You are. Now, the times when you don't earn service credit is anytime you're on leave without pay, and anytime you've purchased additional vacation on top of your earned vacation. So every year you get the opportunity to purchase additional vacation. Well, when you go out on that purchased vacation, you're not earning service credit during that time. Okay, also, if you sell your earned vacation, you don't get service credit for selling that. You get cash, and that could affect the salary component of the formula, which we'll talk about later, but you don't get service credit for that. And you also don't get service credit for overtime, on-call time, and standby time. Now, there are some types of time that are eligible for you to purchase. And essentially the idea here is that there's some type of time in your past or maybe in your future where if the situation were slightly different, you could have earned service credit during that time, but because it was what it was, you weren't able to because that it was against the rules. So here are some examples of that. And then you can come in later to finish my sentence. You can come in later and purchase that time to add to your service credit that we'll put in the formula for you at retirement. So here are some examples of those types of time. If you worked plain old part-time when you started, and this isn't for a temporary agency or under contract, this is just plain old part-time position. Once you got your full-time eligible position, you became an ACERA member, and then that part-time work becomes purchasable. Also, the county's temporary assignment pool, also known as TAP, all that time is purchasable. And also project work, and there's other kinds of work like seasonal work and there's like a whole list that you did before you got your full-time retirement eligible position. Those are purchasable. If you want to see the full list, just go to the service credit page on our website. And you can look at it's acera.org/purchase. Also, those 2 weeks between your date of hire and your date of entry is purchasable. Unpaid medical leave, disability leave, and military leave. During your active membership, when you go out on that leave and then return from that leave, that becomes purchasable. For the medical and disability, it's up to 1 year's worth of time per instance of being out. Redeposits of prior memberships, also redeposits of community property where you had an ex-spouse who got part of your service credit and your contributions, and then they took a refund, so you could actually pay that money back in as a redeposit to get your service credit back. And then other work for other California public agencies where you're not eligible for their pension. So I'm not going to take a deep dive into service credit purchases during this seminar. I do that during the new employee/mid-career seminar. If you want to go back and watch one of those videos, we do take a deep dive into the nuances of purchasing credit and how to do it and whether it's a good idea. So I recommend checking out one of those videos. And feel free to just skip ahead to that section. Okay, one more thing though that I do want to talk about regarding service credit is what happens to your unused sick leave, because this is important to your retirement. This is important to the period where you're planning to finally retire. Okay, so if you go straight into retirement, which means that you don't spend any time as a deferred member. Now, remember I said a deferred member is where there's time in between your date of termination and your retirement date, because you're terminating and you're deferring your retirement to a later date. So if the two dates are consecutive, your last day of work or active, basically your last day on payroll, also known as your last day on active employment status, is the day before your retirement date. Or another way to say it is your retirement date is the next day after your last day on payroll. That means you're going straight into retirement, and we will convert your unused sick leave into service credit on a 2-to-1 basis. So you're basically going to get half of your sick leave as additional days of service credit. Now there's a cap on how much we can convert, and it's in your memorandum of understanding, also known as your MOU. And so you're going to have to read your MOU to see what the cap is. Now, for a lot of the MOUs, the cap is 125 days of sick leave is the max that's convertible. So for example, to give you an example of what would happen if we converted 125 days of sick leave, what we do is we take that sick leave that you still have on the books up to whatever your cap is, and we divide it by 2, and that tells us how many days of service credit to add to your service credit number that we're going to calculate in the retirement formula for you. Now, this is business days. This is not calendar days. So you don't work 7 days a week, probably. You work 5 days a week, perhaps. A lot of people do. And so that actually equals about 12 plus work weeks, which is about 3 months, if that was your scenario. So it's, a good amount of service credit, 3 months additional that you would get for your sick leave. There's one MOU that I happen to know off the top of my head, unless they've changed it. So you still may want to read about it, but ACMEA, I think, has no cap. And so I think also the unrepresented managers who go along with ACMEA have no cap. Okay. One more thing I want to say about this is the fact that we're converting sick leave does not change your date of retirement. Okay. Your termination date and your date of retirement are kind of like important measurements for your age factor percentage and the cost of living adjustment later on. That we'll talk about that later on. And so your date of retirement and your date of termination are what they are. All this does, the sick leave conversion, is it increases that number of the amount of service credit that we use in the formula for you. Okay, so we talked about the age factor percentage. We talked about the years of service credit that you're earning. Let's talk about your highest average monthly salary. This is the third component of the retirement formula. It's the third factor that we're multiplying together to get your highest average, to get your monthly retirement allowance for life. When you go to retire, in order to calculate this highest average monthly salary, what the law has set forth for us to do is determine your period of highest pay in your career, which is also known as your final compensation period. Okay, that's the technical term for it, final compensation period. Now, this period of highest pay for tiers 1 and 3 is your highest consecutive pay periods, 26 biweekly pay periods if you're paid biweekly, or 12 monthly pay periods if you're paid monthly. And if you're in tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods, depending on how you're paid. So essentially, for tiers 1 and 3, it's your highest consecutive year of pay. And for tiers 2 and 4, it's your highest consecutive 3 years of pay. Now, our goal for the formula is to figure out your highest average monthly salary. So we got to convert years of pay to months. So we take, for tier 1 and 3, we take your total salary during the highest year, we divide it by 12 months, and that gives us the average over that highest year. For tiers 2 and 4, same thing, except it's 3 years worth of pay. So we're dividing by the 36 months in that 3-year final compensation period to get your highest average monthly salary over that 3-year period. And that's the number that we're going to use in the retirement formula for you. Now, what pay goes in here? If it's paid during your final compensation period, your base pay, of course, is going to be part of your pay that is in your highest average monthly salary. Also, some other pay codes could go in there. Sometimes these are known as footnotes. It's other types of pay based on skills and education. I can't tell you off the top of my head which pay codes are in or out of the salary calculation because there's like 1,000 pay codes. So what you need to do is go to our website, acera.org. You can search for pay codes, or you can just go straight to acera.org/pay codes and pull up the PDF for your employer. And there's a pay codes listed out there. And you just find your pay code in there by name or by number, and it will say yes or no whether it's in or out of this calculation. I can tell you that overtime never counts. And if you need more info about particular pay codes, you can ask your payroll manager. Okay, now these are the last two bullet points that can possibly go into your highest average pay. Vacation sales and vacation cash out. Vacation cash out is also known as vacation payoff. Okay. So for these two types of pay, we're only talking to tier 1 and tier 2 people. The reason we're not talking to tier 4 people is because the state passed a law in 2012 that says and this is actually what created tier 4, that same law, that says that no vacation pay can be included in this calculation. So sorry about that. And for tier 3, the Livermore Area Recreation and Parks people, the amount that you're allowed to sell is based on how much you earn and how much the amount that we're allowed to include is based on how much you're allowed to sell and how much you earn. And you're not allowed to sell vacations, so you can't do this either currently. So we're just talking about tier 1 and tier 2 members. Okay, so and tier 4 members can take a snooze for like 15 minutes. Okay. So let me just give you more details about this because people have lots of questions about this. So I have a whole bunch of slides on this. Okay, here's how this works and we're talking about the vacation sales and vacation cash out components of the salary calculation. So vacation sale, also known as vacation sell, is when you sell your vacation back to your employer while you're still employed and you get an extra check or extra money in your next paycheck. That is a vacation sale. Vacation cash out, also known as vacation payoff, is when you have vacation left over on the books at the time that you terminate your employment that you haven't taken yet. And so your employer will cash you out for that vacation at that time. Okay. So this is at termination. It says at termination or retirement. If you're going straight into retirement, it would basically be the same time. So when we're talking about the amount of vacation compensation that may or may not be included in this highest average salary calculation, we're talking about the total between both of these different categories of vacation pay, vacation sale and vacation cash out. We're looking at the total of both, okay? Because there's going to be a limit on how much we're allowed to include, which I'll get to in a minute. So the idea here is that if you are paid for your vacation, your earned vacation that you're not going to take either through vacation sales or vacation cash out during that final compensation period, that makes your total salary during your final compensation period get a little bit bigger. Because your total salary gets bigger, that also makes your average salary get a little bit bigger. Because your average salary, highest average monthly salary, is one of the 3 multipliers in the retirement formula, that makes the product of that formula, your retirement allowance, increase by a little bit. So the bottom line is that getting paid for this vacation during your final compensation period will lead to a higher retirement allowance. Now, how much higher? People will ask. This is kind of a ballpark approximate chart of how what the effect of that would be. Okay. And so in this column, you're looking at the number of weeks of vacation that could be included in the highest salary, and that translates into a certain percentage increase for your retirement allowance. So for example, for a tier 2 member, if you were able to get 8 weeks of vacation pay included in your salary, that would give you a 5% bump on your retirement allowance at the time of retirement for the rest of your life. Okay, so this increase is, kind of why people are interested in this topic, and it's something that we have to do based on the law, so we might as well tell you how it works. Now, there's going to be a cap on how much vacation compensation Sarah is allowed to include in your salary. Okay, so I'm going to show you what that cap is for, first of all, Alameda Health System employees, and then I'm going to show you what the cap is for everyone else. Okay, so Alameda Health System employees, you get out your retirement planning worksheet and you look, it's on the second page, you look at this section. Okay, now what you're going to do is you're going to put in your hours of PTO that you earn per pay period in this field here. Okay, so in this example, we're going to say it's 6.7692 hours of PTO that you earn per pay period. Alameda Health System employees earn vacation and sick leave differently than everyone else. It's all in this one bucket called PTO. So that's why we have to do a calculation that's a little bit different for you all. So you put your hours of PTO that you earn per pay period in this field. And then for tier 1, you're going to multiply by 13. And that's going to give you, in this example, 88 hours is your limit of the maximum amount of vacation pay that we can include in the salary calculation for you. For tier 2, you multiply it by 39. And in this example, it gives you 264. Okay. Now the exception is that for AHS employees in the UAPD union, your limit is just a flat 120 hours of PTO for tier 1 and 360 hours of PTO for tier 2. Okay. Everyone else, you're going to use, this calculation here. Okay. So that is how you determine the max hours of vacation compensation that a Sarah can include in the highest average monthly salary calculation for you if you work for Alameda Health System. Okay, and looks like I left a note on this for myself last time I did this, and I didn't actually get around to editing this. So let me just take that note off real fast so that it's not in our way. Okay, sorry about that. Oh, looks like I have one more note down here. Okay, where did we leave off? Okay, I'm having somebody, let me check the questions here before I move on here. Okay, there's a question. If there is a deferral period, the vacation cash out happens upon separation or upon retirement? It happens upon separation. So I think it might, if you terminate and defer your retirement to a later date, it's always going to happen at termination. So it might be like in your last paycheck that you get 2 weeks after your termination, or there could be a separate check. I'm not exactly sure how it works, but it does happen at that time. Restate the URL where the worksheet is. Absolutely. So you're going to want to go to out to sarah.org, and in the top menu, you're going to go over to news and events and go down to retirement planning seminars. Okay. And so it's a sarah.org/seminars if you just want to go straight there. And then you just scroll down to pre-retirement webinar, and there's a link there for the retirement planning worksheet. Okay, and then there's a question, how about for general members? This is actually going to be for this vacation thing. It doesn't matter between general and safety. It's all the same. And I'm about to do county and other employees. Okay, and then there is a question regarding the AHS. So you've been told that the Alameda Health System Tier 2 limit vacation sellback is 160 hours per year, but the slide says 264, which is correct. The slide is going to be correct based on your calculations. So if it could be that somebody at Acera helped you with this, and whatever your hours of PTO that you earn per pay period is, when you multiply it by 39, it comes out to 160. So that could be the case. You're going to want to go ahead and do this calculation again. Another thing that might have happened is maybe you heard that prior to, let me see, I think it was June, when the Board of Retirement decided to slightly modify how these calculations are done based on a new interpretation of state law. And so it made the amounts slightly different, and they, in a lot of cases, they got a little bit less. So it could be that it's an old calculation that you're looking at as well. So you're going to want to go ahead and do this calculation again. And then there's a third question. You're saying the max rate is 2.43%. And I think what you're referring to is for Tier 2 general members, the maximum age factor percentage is 2.43%. That is totally different. These are two totally different concepts than this percentage increase. Okay. The 2.43% for the age factor percentages is the percentage of your service credit that you're going to get, the percentage of your salary that you're going to get for each year of service credit. So that's one of the factors in the retirement formula. This percentage is not something, this is not an actual calculation that we're going to do. This is just a table that I made to kind of give you a ballpark on how the vacation sales and cash out will affect your retirement allowance. And so what you would do with this percentage is you would kind of take what you know your an estimate of your final retirement allowance to be after the full retirement calculation has been made, and then you would add like 5.1% to it if this is your scenario. So you would multiply it by 0.051, and that would tell you what the new retirement allowance would be with the increase from the vacation. Okay, so to pick back up where we left off, for everyone else who does not work for Alameda Health System. So this is for everyone who works for Alameda County and all the other employers. And we're talking again about Tier 1 and Tier 2. The way that you are going to calculate your limit on how much vacation compensation we're allowed to include in the highest average salary calculations by using this part of the worksheet. Now, what you're going to need to know is how much vacation you earn per year and how much vacation you are allowed to sell per year, also known as earned and payable. So the earned is how much you earn per year. The payable is how much you're allowed to sell per year. And you need to break it down for Tier 2 members by 3 years. So each one of the 3 years in your final compensation period, you're going to need to know these two numbers for each one of those years. Okay. And so you put those in here. So to give you an example, this person earns 5 weeks of vacation per year in their first year, and they're allowed to sell 2 weeks of vacation per year. Okay. Now, in this example, that number is the same for all 3 of those years if they're in Tier 2. Okay, so for Tier 1, you only need to do it to fill out these 2 first boxes. For Tiers 2 and 3, you need to fill out all 3. Okay, for the vast majority of you, probably 95 or more % of you, all 3 of these numbers are going to be the same. You're earning the same amount each one of these years, and the amount that you're going to sell, that you're allowed to sell, is the same for each one of these years. But for some of you, during that final compensation period, there is going to be maybe an increase in how much your vacation you're earning per year. So you would want to put, maybe you went from 4 to 5 at some point. So you would want to put that in here as well. Now, if you shift from 4 to 5 during the particular year, then you would put in the 5, because that's how much vacation you earned the most during that 1 year period. Okay. So what you got to do is you got to take these numbers and you got to go out to the calculators on our website. Okay, now here's a screenshot of the calculators. I'll just go ahead and go out to the calculators, and they're at acera.org/vacation. So let me just go ahead and show you those live, and we can plug these numbers in. So I'm going to go to acera.org/vacation. And so these calculators are brand new, because this is how we have to do it now, since the Board of Retirement changed their interpretation of the law. Now you're going to want to pop open this accordion here that says Alameda County Courts Housing Authority Employees. There's 2 calculators in here. There's a tier 1 calculator and a tier 2 calculator. So we'll use we'll do a tier 1. We'll do it for tier 1 and tier 2. In that first scenario, tier 1, that person was earning 5 weeks of vacation per year. So you delete the zeros in there and you go to 5. And then you select from the drop down the amount of vacation that you were allowed to sell per year. That's 2 weeks. And so the calculator will tell you that your maximum weeks of vacation compensation includable in your highest average monthly salary is 2 weeks. Okay. And so you would go put that in the worksheet here. Now for tier 2, we're going to do the same thing, except we need to put it in 3 times. And what the calculator is actually doing, it's a basically simple calculation, is it's taking the lesser number from each one of the year periods, and it is adding those 3 together. So, excuse me. In this scenario, it's going, which is less, 5 or 2, 2, which is less, 5 or 2, 2, which is less, 5 or 2. And then it's adding those 3 up to get the 6 weeks. Okay. So if I were to increase this one to 3, it's 2 plus 2 plus 3 is 7. So that's why it works that way. So then what you do is you go back to the worksheet and you put your limit that you learned from the chart, from the calculators. And that's what I was making a note to myself. It should say limit from calculator, into this field here. So now we know what your limit is. That's the number that you're looking at. Okay. So for the AHS employees, it was in hours. For you, the rest of you all, it's in weeks. Okay. So 6 weeks of vacation in this example is the maximum amount of vacation compensation that we're allowed to include in the salary calculation. Okay, now people ask questions about vacation sell versus vacation cash out. If you remember, what we're doing is we are looking for a combination of vacation sell and cash out. Okay. For the AHS employees, it's super easy. You just don't sell any vacation. You just cash out whatever the limit is. Okay. For the county employees, it's mostly the same. It's the limit is going to be such that you just need to have this limit on the books when you're retired if you're trying to max this out, and that's fine. Okay. And that would be like this scenario here. You just have 6 weeks on the books. When you cash out, when you retire, you don't worry about selling any. 0 plus 6 is 6. That gets you up to your limit. Okay. Now, let me do a different scenario for you all. And there's a question I just saw pop up. Has this changed since last year? Yes, this has changed since last year. This changed in June. Okay. Like I was saying earlier, the Board of Retirement took a new interpretation of the law that governs these. And so this calculation has changed. Okay. So it's likely that it's less for you. It says at the time you could do 12 and now it's 9. That is, yeah, that's probably the case. So sorry about that. The good news is that you earned another year of service credit between the last time you calculated it and now, so your total retirement is going to be higher. Yeah, sorry about that. Okay, so, and then there's a question up there. I'm going to take 2 months of vacation and then retire. So this does not affect me. Please advise. Okay, good question. And I will get to that in just a minute. Okay, different scenario. In this scenario, this person, we're going to do a tier 2 scenario again. This person earns 4 weeks of vacation every year that they work. So they're earning 12 weeks of vacation over the 3-year final compensation period. Their employer's rule is they are allowed to sell 3 weeks of vacation each year that they work if they want to. So we put that rule in here. We go out to the calculators and we find that their limit from the chart is going to be 9 weeks. Now, the issue here, the reason I'm calling this out is because your employer has an additional rule about cashing out your vacation, which is that they will only cash you out for 2 times your accrual rate, your annual accrual rate. Okay. So in this case, when this person stopped working, their annual accrual rate was still 4 weeks of vacation. 2 times 4 is 8. Okay. So their employer will only cash them out for 8, but their limit from the chart is 9. Okay. So how do they get up to the 9? Well, this is when you might want to sell vacation. So in this scenario, they would want to sell 1 week of vacation, plan ahead, sell 1 week of vacation while they're still employed, and then cash out that 8 weeks, and that will get them up to the 9. Okay. Now, the only reason that you need to do that is if you're in this scenario where you can't get up to your limit because with cashing out because the 2 times your accrual rate is less than your limit. For everyone else, in the earlier scenario that I gave, 2 times the accrual rate here is 10 weeks. Their limit is 6. They are not even getting anywhere close to 2 times their accrual rate with what the limit is. So they don't need to sell any. Okay. They just need to cash out the 6. Now, I do get the question. People ask me, okay, well, I didn't know this until I'm watching this now. What do I do if I already sold a bunch of vacation? Well, that's fine. You sold vacation in the past. You got the cash for that vacation. That's great. You got extra cash. Okay. Now, you have 2 options. What you could do is cash out the difference. Okay. So you know how much you sold. You know what your limit is based on the calculators. So you just, do a subtraction. 9 minus 5 is 4, and you just have 4 weeks on the books when you retire to get up to the 9. Option 2 is that you could even cash out more if you want to, and it's not going to be detrimental to you. Okay. What would happen if you did that is, yes, you sold 5 weeks of vacation while you were still employed and you got cash. Great. You put that in the bank. Then you go to retire. You have 8 weeks of vacation on the books. So you get cash for that. Great. You put that in the bank as well. And then your limit is still going to be 9. And we're just going to take, you're just basically going to get 9 weeks worth of vacation pay because you're over the limit. So we're going to limit it to 9, essentially, is what's going to happen. The actual calculation is slightly different, but it's essentially going to be 9 weeks worth of vacation pay that we're going to include in your highest average salary. And one more thing that I want to be clear on is that whenever you sell vacation or cash out, you're getting actual cash that goes into your bank account. This number, this limit here, and the weeks of vacation that we put into your salary calculation, those are all just numbers based on what you actually physically cashed out and put in your bank account. Okay. So before I welcome back the tier 4 employees, let me get to this question here and see if you all have any more questions on this topic. So there's this one question. I'm going to take 2 months of vacation. Presumably, you're saying you're going to, before you retire, you're going to take 2 months worth of vacation. So we're talking 8 weeks worth of vacation, essentially, which means you're going to physically not go into the office or wherever your workplace is 2 months before your actual retirement date. And then for the last 2 months, you're going to be on vacation leave. So you're going to be getting your paycheck for 2 months. You're going to be earning service credit for that 2 months. And then at the end of that 2 months is going to be your retirement date. And so you're going to go in from active payroll and straight into retirement. And that's going to be fine. Okay. So you can do that if you want. Okay. If you do that, you do get that extra 2 months of service credit. Okay. Now, let me give you a different option that you could do. rather than pushing your retirement date out 2 months and getting that 2 months extra service credit. Instead, you could pull your retirement date back to the time when you actually want to stop going to your work site. Okay. And then you have that 2 months, let's convert it into weeks, that 8 weeks worth of vacation. Okay. On the books. And if you have the 8 weeks worth of vacation on the books, that would be like an 8 week cash out, and that would give you this salary boost. Okay. So, and if you want to write back in and tell me what your tier is, and tell me what your amount of vacation that you earn per year is, and amount of vacation that you're allowed to sell per year is, I can maybe help you do the calculation. But just looking at like what the increase could be for that 8 weeks worth of vacation, if you're in tier 2, you could get a 5% boost to your retirement allowance at the time of retirement. And that extra, in the other scenario that you're thinking about doing, the extra 2 months worth of service credit, that is not going to get you anywhere near a 5% boost. It'll probably be way less than 1%. The boost that you get from this vacation sales and cash out thing is like way more than you get by actually taking the vacation. So I would just, let you know that that's another option that you have besides just taking the vacation. Okay, and let me see here. I have a bunch of more questions. Okay, so there's one person writing in, if I get a cost of living adjustment in January and I retire in November, does it matter when I sell vacation after January, during the year, or at retirement? So you're getting an cost of living adjustment as an active member in January, and then you're going to retire later that same year in November. So presumably, well, and so you're thinking about like how much you're actually getting paid for the vacation. Let me think about how I can explain this, because I'm also still wrapping my mind around this. The limit on how much of this vacation we're going to include it's not exactly like this, because this is the easiest way for us to explain it to you, to do it in like weeks of vacation and not convert it to money. But what we are really going to do to find your limit is convert it to money. So like for the tier 2 members, we're going to look at all of your pay periods in your final compensation period, and we're going to find the week where you could have gotten the most money in that first year, the week you could have gotten the most money in the second year, the week you could have gotten the most money in the third year. We're going to see how much money you could have gotten by selling vacation in each one of those 3 periods. And the total of those 3 becomes the actual limit in terms of a dollar amount, okay, of how much vacation is includable in the salary calculation. Now, the reason that we don't explain it that way is because it's more complicated. There's a lot of different iterations, and what you're going to get is basically, you can kind of look at it as, just weeks of vacation pay. But to your question, you're asking like, if I cash out the vacation pay at the end, because I'm getting a cost of living adjustment, I'm going to get a little more for that vacation. Is it going to change the limit? Not really. It's not going to change the limit. It could be it could be better for you, especially if you're not planning on having the limit on the books when you retire, or like getting, a Sarah including the limit in your salary calculation. It could be better for you to cash out rather than sell. I just think that, this is kind of getting into the weeds. I just think that the easiest way to think about it, okay, so I'll get out of the weeds. The easiest way to think about it is cash out, do most of it in the cash out, most or all of it in the cash out, and only do a little bit of it in the sell, like in this scenario. Um, and don't really worry about selling. Okay. And if you've already sold a bunch and you can cash out the difference, it's not going to be a huge difference one way or the other if you get paid a little less for some of those weeks of vacation in most scenarios. So I guess that's the kind of the shorthand way to think about it, is just kind of focus on what the limit is and try to get up to the limit any way you can. Okay, let me see what other questions we're gathering while I was getting weeded out in the details. Okay, so let's see. The question is there a limit on the number of weeks that can be cashed out upon separation for AHS Tier 2 employees? I don't think there is. I think they're just going to cash you out for what they cash you out for, which I think, and you may want to check with your payroll clerk on this, but I think it's just the remainder of your PTO. And so I think what you cash out is usually going to be higher than what your limit is. But definitely check with your payroll clerk on that. Okay, so one person's saying 6 weeks max for Tier 2 or 9 weeks. Well, it all depends on how much you earn and how much you're allowed to sell. You have to go out and use the calculator to determine what your limit is going to be. So yeah, I can't say as a blanket statement, everyone in Tier 2 is going to be different based on how much vacation you earn and how much you're allowed to sell. Okay. So this person is saying I'm Tier 2. I have 12 weeks of vacation before the retirement. What should I do? So I guess I'm taking that to mean that oh, sorry, I skipped a couple of people, but I'll get back to you. I'm taking that to mean that you have 12 weeks of vacation on the books before retirement, and you're Tier 2. What should you do? I think in most cases, I don't think anyone earns 6 weeks of vacation per year, which you would have to be earning to be able to cash out that much, 12 weeks. So you're probably earning 5 weeks of vacation per year or 4 weeks. You're going to want to either take the vacation, anything that's above 2 times your accrual rate, you're either going to want to take it or sell it. Okay. So like for this person here in this example, 2 times their accrual rate is 8 weeks, right? So anything that they have on the books above the 8 weeks, you're going to want to take the vacation or you're going to want to sell it. Okay. You don't want to lose it. Anything above this 8 weeks in this example is just going to disappear. So you either want to take vacation or sell vacation. Okay. So that's what you should do with that. Then let me go back up here. So this person is saying, I learned that instead of receiving cash money on vacation cash out, we can deposit the cash out money to the deferred compensation account. Yeah, you can do that. And you can ask our deferred compensation provider in the post session about that, about how to do that. You can, whatever you do with the money, we don't care. It's just the act of cashing it out comes through on your payroll record. And that's what we're looking at when we're talking about how much you actually cashed out in order to add that to your salary calculation. So whether you want to roll it over into deferred comp or just put it in your bank account, that is totally up to you. And it doesn't change what we do in terms of the this vacation calculation. Okay, next question. And I think I may want to move on after I answer all these questions so that we can keep the presentation going. So the question is, I'm in tier 2. Do I need to sell weeks of vacation? Sell 2 weeks of vacation every year for 3 years to add it to service credit calculation, or can I save the 6 weeks and include it the calculation when I retire? I take that to mean that you are in this scenario where your limit from the calculator is 6 weeks. You absolutely do not need to sell 2 weeks of vacation every year for 3 years. I advise you, it's way easier to just have that 6 weeks on the books. When you retire, you'll get cashed out for it, and that will be included in your salary calculation. So that's way easier than taking time to sell vacation. Okay, so then I think this may be a follow-up question. In other words, if I've had my last raise, does it matter when I sell? If you've already had your last raise, does it matter when you sell? I don't think it does. It doesn't matter when you sell or just if you cash out. I don't think it matters. So it's a question, how does this work when my vacation is capped at 5 weeks? And I take that to mean that your limit from the chart is 5 weeks. So all you need to do is put your limit from the chart. And when I say chart, I mean calculator. It used to be a chart, now it's a calculator. Your limit from the calculator is 5 weeks. So all you need to do is figure out how to get up to that 5 weeks between vacation sell and vacation cash out. If you can get up to the 5 weeks based on cash out, just have 5 weeks of vacation on the books when you retire. That gets you up to your 5-week limit, and you're good to go. Okay, the next question. If you get the vacation boost for your retirement, do you also get that time paid to you in cash, or do you lose it? Oh, no, you definitely get the cash. You get the cash, and because you get the cash and it goes through in your payroll records, that's what allows us to put it in as salary for the boost in terms of calculating your highest average monthly salary. If my next question, if my limit is 6 weeks, does it make any difference if I sell 2 weeks per year for 3 years, or if I sell 6 weeks as a vacation cash out? I don't think it really makes a difference. So you can do whatever you like. You could sell 2 weeks per year over the 3 years, or you could cash it out at 6 weeks. I really don't think it makes a difference. Okay, and then does cashed out vacation get added to the final average salary? Yes. So the highest average monthly salary is the same thing as final average salary. Those are two synonymous terms, also known as FAS. And yeah, absolutely. That's exactly what we're talking about. If you cash out vacation, we'll add that salary up to your limit from the calculator to your highest average monthly salary. Okay, next question. 6 weeks limit, and the extra weeks can still be cashed out. Oh yeah, absolutely. So that's what I was kind of saying in this example. In this example, it's a 9-week limit. But if you happen to, between the sales and the cash out, if that happens to be over your limit, that's fine. You're still going to get all the cash. Like in this scenario, this person, they sold 5 weeks of vacation. They got 5 weeks worth of vacation cash. And they cashed out 8 weeks worth of vacation at the end. They got 8 weeks worth of cash. They get to put all that 13 weeks in their bank account. It's just that we can only take 9 weeks worth of that pay as salary for calculating their salary. And then finally, last question on this, and then I'm going to move on. On tier 2, 30 years of service credit is my maximum 6 weeks or 9 weeks to include in the retirement calculation. So you need to calculate that for yourself. And the calculation is you're going to, on the worksheet, you're going to fill this out for yourself. The calculation is based on that calculator, that online calculator that I was showing you. So on your retirement worksheet, you're going to have to fill this out based on how much vacation you earn per year in each one of the 3 years and how much you're allowed to sell per year in each one of the 3 years. And then you have to go out to acera.org/vacation and open up the calculators for Alameda County. And then you're going to have to put in those numbers into the calculator, and it's going to tell you what your limit is. Okay. Okay, moving on. Thanks for bearing with us, everyone, while we take a deep dive into that. It's kind of complicated, so it takes a while to explain. Okay, so these, and I'll just touch on this briefly. These are the limits on your retirement allowance. So once your allowance is calculated, these are kind of the limits on that. The first limit is that your retirement allowance can't be more than whatever we calculate your highest average monthly salary to be. Okay, so it's capped at 100% of your highest average monthly salary. This is kind of trying to prevent you from making more in retirement than you were making as a working employee. And it basically does that, except for, as we just learned, your highest average salary can be a little bit bigger based on that, vacation compensation. But otherwise, it pretty much caps you at that. These next two limits, 415B and 401A17 limit, I'm not going to really talk about. Those are for people who have really high salaries. So if you have a really high salary, you're going to want to go ahead and read that information. And then for tier 4 members, there is a limit on how much of your salary annually we are allowed to include when we actually go to do the highest average monthly salary calculation. So for general members, the current limit is $128,059. For safety members, it's $153,671. If you make more money than that, we can't include any money above that as salary for your highest average salary calculation. So it's capped. Now, these limits go up every year. That's the bad news. The good news is that whenever you reach that limit in the year, we stop taking out retirement contributions from your salary. So that gives you extra money to save in your 457B plan. And sorry, this says 2020 benefit limits. These are actually the 2021 limits. Okay. So let me help you get an estimate of your retirement allowance. This is the estimating my retirement portion of your worksheet. And I'm going to show you two ways to do it. We're going to do a ballpark estimate, and then we're going to do a precision estimate with a retirement calculator. The first one we're going to do is the ballpark estimate. So go ahead and look at the ballpark estimate section of your worksheet. You're going to think about the retirement scenario that you want an estimate for. I'm going to retire at age 58, okay, in this scenario. Then you're going to want to think about how many years of service credit you will have earned in this scenario where you're retiring at age 58. In this scenario, I will have earned 29 years of service credit. So I'm going to take those two numbers, and I'm going to go out to the charts that we have out on our website that help you get a ballpark salary percentage. So you can go to acera.org/ballpark. I'll show you how to navigate to it. All you do is you go under members, you go to planning your future retirement income, and then it's the first thing under step 1 is buttons with these charts. So for example, if I'm in a general member in tier 2A, I think that's the example that I'm doing. And I'm retiring at age 58 with 29 years of service. So I'm going down to 29 years of service, going over to age 58. That means I will have achieved a 50.03% salary replacement. Another way to say it is I'm going to get 50% of my salary, my working salary in retirement as my retirement allowance. So then what I'm going to do is go back to the worksheet and put that 50.03% in here. And then all you need to do is kind of think about what your monthly salary is, and just think that, let's say that it's $6,000. And in this scenario, you're going to get half. So you just multiply these two together. 50% of 6,000 is about $3,000. So that's kind of how to get a ballpark estimate. Now, let me show you a different way to do it. This is the precision way to do it using the online benefit estimator in your account in our member portal that we call Web Member Services. So you go out to acera.org/WMS, or you go to acera.org and you click the login button. Now, in this scenario, what you need to think about is a separation date and a projected retirement date. So just think like, I'm going to retire 3 years from now, for example, and you just kind of pick a date that matches you retiring 3 years from now. Or if you happen to know like the exact dates because you're going to retire really soon, you can put those in here and do it. Now, the separation date is your last day of work, your last day on payroll. Your projected retirement date is your first day of retirement, and it has to be at least the next day after your separation date. Okay. So you write those in on your worksheet. You go out to our website. You press the login button. You log in. The first screen you're going to see is the account summary. You click estimate a benefit. And this is where you're going to put in that separation date and projected retirement date. Okay, so I'm just going to zoom in here on the screenshot so you can see it a little bit better. And so you put in your separation date and the projected retirement date from your retirement scenario, you hit calculate, and it's going to give you a projection of how much service credit you will have earned in this scenario. It's also going to give you a salary projection for, it's basically projecting your final average monthly salary, your highest average monthly salary. Okay. You do have the opportunity to override both of those numbers. If you want a nice conservative estimate, I recommend not overriding them. Okay. And just doing the calculation as it is. But if you did want to see like the effect of, like the sick leave conversion, for example, where we said you get like another 3 months of service credit, what you would want to do is add 3 months, basically, since this is in years, a quarter year. So you would add 0.25 to this number that's already there and put that new grand total in the override service credit blank. Okay. Now, you can also add hours of cash vacation compensation. Let me show you what that looks like without doing it first. So you leave that blank and you can fill in beneficiary information in here and you hit get estimate and you end up with this retirement benefit estimate. This is a PDF that you can save and print out. This is your retirement benefit estimate. And for the time being, you can just kind of look at this unmodified option. This is the highest member allowance option. And this is basically your retirement benefit estimate for this scenario. Okay, now, if you did want to see what the impact of vacation compensation is on your retirement allowance, you can do that in the calculator. And there's an area on your worksheet that helps you do this without overestimating. And the reason that you might overestimate is because you may have already sold some vacation that is already being included in that salary projection that the estimator is making. So this part of the worksheet helps you subtract that out. So what you're going to do, step one, is you run an estimate like we just did and leave that hours of cash vacation compensation field blank. Okay. And then you're going to use that estimate PDF to fill in numbers here. Okay. So let's start filling in numbers. The first number that you're going to fill in is your limit from the calculator. Okay. And it's for the county employees and other employees, it's your limit in weeks. And we're going to want to convert that to hours. And so if you work for 40 hours a week, you multiply it by the number of hours you work, or if it's 37 and a half, you put that in and you multiply that, and that gives you your limit in hours. Now for Alameda Health System employees, we already know your limit in hours, so you just start here and you put in your limit in hours. Okay, now you're going to need to subtract out hours of cash vacation that you already sold. So you go to that estimate that you made, you look at this date range and you think back, how many hours of vacation did I sell during that period? If, for example, you sold a week's worth of vacation during that period, then you would put in a week's worth of hours in here, and you're basically subtracting that out from your limit. Okay. And then you take that number, and that's what you would put in here for hours of cash vacation compensation. Now, if you happen to know that you didn't sell any vacation, then you don't need to do that. All you need to do is put in your limit in hours here. And then you can see what the effect of that additional hours of cash vacation compensation would do to your retirement estimate and a get estimate. And then and it will actually show you how many hours of vacation compensation it's including in the estimate. And like I said, this is these numbers are your retirement estimate for your retirement allowance. And we'll talk about what the different options a little bit later in the presentation. Okay, so for right now, if you just want to use the unmodified option number, you could put in that number as the precision estimate number on your worksheet. So that is two ways to get a retirement benefit estimate. There's a third way, which is you could fill out our retirement estimate request form, and one of our retirement specialists will do all that for you. But there's a wait for that. Like you're going to go into a queue. It might take some weeks to get that back. Whereas they're going to be using the same software and math as our web member services portal. So you're going to get the same answer either way. So I highly recommend just doing the benefit estimator in your account. And it's we call it a precision estimate because it is just that it's pretty precise. Okay, and regarding the cash out limit for AHS employees, so if you recall on your worksheet, there was a spot for that. So here's the worksheet. It's this area right here that is the place where you calculated what the limit in hours was for you. Okay, so it's going to be different for everyone. And so you have to calculate what that limit is. And then when you want to do the area about like figuring out how many hours of cash vacation compensation to put in the calculator, then you take that number of hours and you put it down in here. And this is where you start for AHS employees. So you would just transfer this number down to there. Okay. Okay, so next item on the checklist is verifying your retirement eligibility. We're talking about this spot on the pension milestone chart here. I'm going to show you a slide for tiers 1, 2, and 3, and then a slide for tier 4. So the way you become eligible to retire is you meet one of these three scenarios. You meet the criteria in one of these three scenarios. Option 1 is that you are over age 50, you have at least 5 years of service credit, and you have at least 10 years of membership in ACERA, and you are eligible to retire. Now, the reason that there's a difference here between service credit and membership, I don't know why they wrote the law that way. For the vast majority of you, that it doesn't matter. You can just think of it as having 10 years of service credit. If you're going straight into retirement, you just have 10 years of service credit. That means that you also have 10 years of membership and you're over age 50 and you can retire. But for some of you, if you're going to leave early before you reach 10 years of membership, then you would simply want to make sure you have at least 5 years of service credit and at least 10 years has passed from your date of entry and you're over age 50, then you can retire. Okay, option 2 is you can have, as a general member, 30 years of service credit, and as a safety member, 20 years of service credit, and you can retire at any age, even if it's younger than age 50. Option 3 is that you can retire at age 70 with any amount of service credit, even if it's less than the 5 years of service credit you would need under option 1. Okay, for tier 4, to reach retirement eligibility, you need to meet the criteria in one of these two scenarios. Option 1 is that you are age 52 or older as a general member, or age 50 and older as a safety member, and you have at least 5 years of service credit. You don't have to worry about the years of membership thing. Option 2 is that you can retire at age 70 with any amount of service credit, even if it's less than 5 years. And that is how you become eligible to retire. Okay, now that you know your retirement eligibility date, you can put that in right here. Or if you happen to know you're already eligible, you don't have to calculate what the exact date was that you became eligible to retire. You could just say, I'm eligible in here. Okay. That topic was quick. So we got that checked off. The next thing I'm going to help you do is choose your retirement date. And I did get a question during the break time about this. So this is where I'm going to help you figure out how to choose your specific retirement date. We are talking about this day on the pension milestone chart right here. Your retirement date, a date that you choose. There are 6 things you're going to want to think about. And we'll go through each one of these. We're going to talk about your income. We'll talk about age factor percentage dates, the cost of living adjustment, if there's a disagreement between those 2 things. And then we'll talk about choosing your actual date. I'll just touch on this briefly because I'm sure you don't need a lecture on this. But this is something that is a good idea to, just kind of peek into the future and, kind of know in advance what your retirement situation is going to be regarding your income after retirement. And so it's good to go ahead and get a SARA retirement estimate like we were just talking about. It's also good to know how much money is in your deferred compensation account if you have one, or other investments and savings that you have. It's also a good idea to go out to Social Security's website and get an estimate from them for how much they are going to pay you when you're eligible to collect Social Security. And if you want to, this is kind of extra credit, but you could even calculate what your post-retirement expenses might be. Calculate your income after retirement in these 3 categories, combined, and, make sure that you have enough to pay your expenses. What financial planners will tell you is that you're going to need 70 to 80% of your pre-retirement income that you were making before retirement. You're going to need that in retirement to maintain your standard of living. Okay. So that is just kind of a shorthand way to, if you don't want to do this, dive into what your post-retirement expenses might be, all you might want to do is add up your SARA retirement estimate, your Social Security estimate, and then just, see how much savings you have and see if that gets you to 70 to 80% of your pre-retirement income. I do take a deep dive into this topic during the new employee / mid-career seminar. So if you want to go look at that retirement planning information, it's at the end of the presentation. In that one, you can go back and watch one of those videos. There is, I will show you actually before I move on, if you are interested in that, but you don't want to watch the video, there is a kind of much quicker way to do it, perhaps for some people who aren't that much into watching videos. If you go to the preparing to retire section under members, there is there's a post, estimate your retirement income, which kind of takes you through each one of those steps in a little more detail than I just glossed over. And there's like a budget worksheet that you can do and a retirement calculator, so you can try all that stuff out. The second thing that you're going to want to think about when you're choosing your retirement date, or that you may want to think about, I won't say that you're going to want to think about, you may want to think about this, are the age factor percentage dates. Okay, so remember in the beginning of the presentation, I was saying that there are these dates based on your birthday, and every time you pass one of those dates, every time you go a quarter year without retiring, you go up one notch in the age factor percentage chart, and you get a slightly higher age factor percentage in the calculation. So it's based on your birthday. So for example, if your birthday is January 15th, 1 quarter after your birthday is April 15th, 2 quarters is July 15th, 3 quarters is October 15th, and then back to your birthday. So every time you pass one of these days, you get a slightly higher age factor percentage. And we're assuming, when I say that you haven't yet reached the maximum age factor percentage for your tier. If you already have, then you can just, take a little break for a couple of minutes, because this does not apply to you. Okay. So let's say that your birthday is January 15th. Let's say that you haven't yet reached the maximum age factor percentage for your tier. And let's say that you're thinking about retiring on, let's say, July 10th. maybe. Don't do that, okay? Because if you just work like 5 more days and retire on July 16th, you'll get a slightly higher age factor percentage. It will actually increase your retirement allowance by a little over 1% just by waiting those few days, okay? The same goes with all the rest of these. And the point here is I'm not telling you that you need to retire the day after one of these days. What I'm saying is, I just want you to be cognizant of what these days are so you don't retire right before one. Because if you had just, worked another week or whatever, worked even another day to get over that mark, then you go up another notch in the age factor chart and you get the higher retirement allowance. Now, if you're going to retire like midway between one of these two dates, maybe like, 6 weeks after the date, maybe you don't want to work another 6 weeks. And so it's fine. You can just retire midway through. So yeah, I'm just trying to help you not retire right before one of these days and miss out on that money. Okay, number 3 thing that you're going to want to think about, the cost of living adjustment date. It's April 1st of every year. And the cost of living adjustment is an annual increase to your retirement allowance. It's a percentage increase. And it's calculated annually based on how much prices go up in the San Francisco Bay Area as measured by the Consumer Price Index, which is measured by the Department of Labor. So if prices go up, let's say 5% from December to December, that 5% becomes the percentage that we're looking at for the cost of living adjustment. And if you are in retired status as of April 1st, you're going to get the cost of living adjustment for that year. And every year after that, when April 1st comes around, okay? Now, I was giving you the example of a 5% increase in prices, but really you can't get a cost of living adjustment as high as that because there's a limit. The limit is based on your tier. If you're in tiers 1 and 3, the limit is 3%. If you're in tiers 2 and 4, the limit is 2%. Okay, well then what happens to those extra percentage points from the amount of inflation that was happening? Those extra percentage points will dump over into this container that we call your COLA bank, where we save percentage points, CPI percentage points for you for years in the future when maybe inflation is less than the maximum. So maybe next year comes around and inflation is only 1%. Well, we're going to dip into that COLA bank and take some percentage points out to get you up to the 2% or 3% maximum cost of living adjustment, if we can, if you have percentage points. And people who have been retired at least a few years, almost everyone has banked percentage points because inflation tends to be a little bit higher than 3% in the United States on average. And so after some time, everyone has a COLA bank. And so you just get the maximum cost of living adjustment every year because you have banked amounts. Now, one more thing I'll say about COLA is your first day of retirement can be April 1st. So your last day of work would be March 30th. Your first day of retirement would be April 1st, and you will get the cost of living adjustment for that year. Now, if you retired on April 2nd, you would miss the cost of living adjustment for that year, and you would get whatever next year's cost of living adjustment would be when the next April 1st comes around. And then every April 1st after that, you're going to get the cost of living adjustment. Okay. So yes, it is a good thing to be cognizant of that April 1st date and to know what the cost of living adjustment is going to be. We always know it in about early February, and we post it out on our website, because if the cost of living if there's a cost of living adjustment, and there almost always is, because there almost always is inflation, then you make more money if you retire before April 1st than right after April 1st. Okay, so that's why a lot of people retire in March. Okay, now sometimes there is a conflict between the age factor percentage dates and the COLA date. So let me give you a scenario for that. Point of clarification question. This is only about the retirement date and not the separation date. Correct. So yeah, separation date doesn't matter when we're determining that first year of COLA, and also when we're determining the age factor percentage date. Because you can terminate your employment, defer your retirement to a later date, and you're going to keep getting older and older and older, and you're going to keep passing those quarter year age factor dates. And so your age factor percentage is going to keep going up. Okay, now if there is a conflict between the age factor percentage and the COLA, as there sometimes is, what do you do? So let's stick with the January 15th birthday example. Now, I'm saying this is general member age 54 just to highlight the idea that this person has not yet reached the maximum age factor percentage for their tier. And they're going to retire in the spring. So they're thinking, what do I do? Do I retire on April 16th or April 1st? If I retire on April 16th, I'm going to get that age factor increase because I'm passing the date of April 15th. So I'm working April 15th, retiring April 16th. So I get that age factor increase. But I'm going to miss out on the cost of living adjustment that happened a couple of weeks ago. Or should I retire on April 1st, get the age factor, get the cost of living increase, but miss the age factor increase that I'm going to get in a couple of weeks? Which do I do? Well, you probably already know the answer because I already gave you the percentages. But if the cost of living adjustment for that year is the maximum, then you go with the cost of living adjustment because it's going to be a 2% increase or a 3% increase based on your tier versus a 1% increase. It's a little over 1%, but it's like 1% and a little bit of change based that you would get for the age factor increase. So in that case, you would just say, okay, I'm just going to miss the next age factor increase. I'm going to go with the COLA. Another point that I want to make here is that the people stress out on these dates, and you don't really need to stress out because, like, for example, in this scenario, if you weren't going to retire in the spring, let's say that you decided, well, I need to work a little bit more, earn a little more retirement. I'm going to retire in the summer. I'm going to retire, let's say, July 20th. Well, in that case, I would have passed April 15th. I would have passed July 15th. I would have gone up 2 notches in the age factor chart. Plus, I would have made 3 more months worth of service credit. And that would beat the cost of living adjustment, whatever it was. So yeah, there was a time right after April 1st, usually, where it would have been better if you had retired before April 1st. But it quickly resolves itself because you just keep earning more and more retirement between the more service credit that you're earning and the more age factor dates you're passing. And so it'll resolve itself after, 2 to 3 months. And then if you've already reached the maximum age factor for your tier, you don't even need to think about those dates. Or if you're not going to retire in the spring, you don't even need to think about the COLA date because you're just going to retire in September or November or June or whenever it is. And whenever April 1st comes around, you're going to get the cost of living adjustment. Okay. So the main reason I talk about the dates is, just so that you don't retire right misaligned with one and kind of miss out on a little bit of money. Okay, I have a couple of questions here. One comment, it says you're trying to get a Social Security estimate over on their website, and you're getting a message that they're sorry, they can't process your request. Please try again later. Yeah, I mean, their website might be down and they might be repairing it. You could just, try again later, or you could see if you could give them a call and see if they have a solution for you. Okay, and then there's a question. Can this person in this example retire on April 17th and take both the age and COLA increase and bank any of the overage? No, because in order to get the cost of living increase for that year, we have to have a cutoff date every year, and the cutoff date is April 1st. So if in what you're talking about is retiring on April 17th, that means this person in this example missed the April 1st cutoff date. So they can't get the cost of living increase because that date has already passed. But they will get the cost of living increase when next year's April 1st COLA comes around. Okay. Okay, the fifth thing that you're going to want to think about when you're picking your retirement date is you want to retire or you may want to do this. And the reason that you would want to do this is back to a topic that we addressed earlier. If you want us to do that sick leave conversion for you, where we're converting half of your sick leave to service credit up to a cap, you're going to want to do this, which is retire on the day after your last day of work. Okay. Another way to say it is your first day of retirement is the next day after your last day of work, or another way to say it is the next day after your last day on payroll, or the next day after your last day on active employment status. Okay. It's okay if you're on leave that day. You can be on sick leave, on vacation leave, on floating holiday, on comp time, whatever. You're still on active payroll status if you're on leave. And so that counts. But that's your last day on payroll status. And then the next day is your first day of retirement. This is the day, your retirement date, that you're writing down in your retirement application. This day, the day before your last day on payroll status, this is the day that you're writing down on your letter of resignation to your employer. Okay. That means that there's no gap in between those days, and you're going straight from active work into retirement. And that is what that will note that, and we will convert your sick leave on a 2-to-1 basis automatically to service credit. You don't have to do anything to make that happen. It just happens automatically. Okay. So the last thing that I want to tell you about choosing your retirement date is you're going to want to retire on a day after you are scheduled to work. And it should be a non-holiday day. So your retirement date should not be on a holiday. Okay. And I think, if I recall correctly, let me think. I think they told me that I need to go back and verify this, but I think they said that your last day of work should also be a non-holiday day. It's correct out on our website. There's a post that addresses this exact thing, and whatever it says on our website is correct. So you're going to want to check there regarding the holiday thing. But the main point of this slide is that you're retiring on a day after you're scheduled to work. And it's okay if you're on leave that day, like I said before, because you're on leave that day because you were scheduled to work. So here's an example. Your normal schedule is you work Monday through Friday. Okay. Now that means that you don't want to retire on a Sunday or a Monday, because if you're retiring on a Sunday, you're not scheduled to work on Saturday. And if you're retiring on a Monday, you're not scheduled to work on Sunday. The reason for that is because if you do that, Sarah is going to have to insert a deferred day in between those. And that means you're not going straight from active work into retirement, and then you'll lose all your sick leave. Okay. So going back one slide, this day, the day before your retirement day, should be a day you're normally scheduled to work. Now, for some of you, you don't have a normal schedule. Maybe you work as a healthcare professional, maybe you work as a safety member, and sometimes you all can have interesting schedules that don't conform to the Monday through Friday thing. So, and maybe you don't even know your schedule that far in advance. So what you would want to do is wait until it's closer to the time, and when you know your schedule, and then you can choose the exact retirement date. So maybe you can, at this point, pick a week that you're going to retire, and then when it gets closer, then you're actually going to pick the day that you're going to retire, just to make sure that you're on the schedule the day before your retirement date. Now, if you are retiring out of deferred retirement, you don't have to worry about this stuff, because as a deferred member, you already lost all your sick leave. Okay. And since now that we have a better lock on what your projected retirement date might be, you can go ahead and write that in here on your worksheet. And if you're trying to do the thing where you're going straight from active work into retirement, now that we know your separation date is the day before your retirement date. So you can go ahead and write that in as well. Okay, next topic, applying to retire. How do you do that? What does it look like? When do you do it? We'll find out. Here's what the process looks like. Step 1, we want you to go through the preparing to retire section. It's at acera.org/prepare. There's various reasons that we want you to do that. There's a post on providing documents that we need to have on file. It's a good idea to change your Web Member Services username to your personal email address. There's a little bit on there about notifying your department, and there's a template in there for writing a resignation letter if you want to go through that, etc. And in fact, I already showed you that section. There's a few ways to get there. You can type in acera.org/prepare. You can go under members and go to preparing your retirement, or you can just scroll down, and this whole section is links to different posts on that page. And there's a link to prepare to retire section here. There's a bunch of posts in here, and it's kind of in chronological order on the order that we think you should do it, like verifying your retirement eligibility. Maybe you should purchase service credit, et cetera, et cetera. You already did the attending a pre-retirement seminar right now, so you can check that off. So there's a few things in there. And then the last post is the actual applying to retire post, and that walks you through the application process. Let me go back to the presentation. Step 2, set up a ready to retire counseling session. So we would like you to submit the form. It's an online form to set up a ready to retirement counseling session in the 3 to 6 months before your retirement date in order to fully prepare. Okay. Now that form, I'll go back to the website and show you, is right here. It's the second to last post on that preparing to retire page. And it's just a web form that you fill out. You tell us a little bit about you. And what this does is it kicks off the process of your retirement. We will we'll give you a call. Once we get this form, we're going to start doing some preliminary calculations, and it just makes it so that your retirement process goes, efficiently and smoothly. Okay, step 3 is that you're actually going to submit a retirement application. So this is how you retire, and you're going to do that within the 90 days before your retirement date. You can't submit it earlier than that, but within that 90 days, you can do it. And like I said, the last post on the preparing your retire section is that retirement application walkthrough, and it will walk you through the whole thing. Step 4 is an option election agreement. Now, this is very soon going to be combined with step 3, because we are about to launch a new retirement application where the option election is combined into the retirement application. So you won't have to do this in 2 steps. Now, for your retirement application and the option election agreement, you can submit those during the counseling session, and we would recommend that. And the counseling sessions, currently we're doing those over Zoom. And what happens is once you set up the ready to retire counseling session by filling out that form, we're going to call you and set an appointment for you. And the appointment is going to be for within the 90-day period before your retirement date. So you'll meet with us within that 90-day period over Zoom or on the phone if you prefer. And we'll answer all your questions. We'll make sure everything's in good order, and we will help you submit your retirement application if you would like help. Okay. And then step 5 is retire, because once the date passes that you have written down on your retirement application, you're retired. Woohoo! It's amazing. You're going to finally be retired and start drawing that pension that you've been earning this whole time that you've been working. So congratulations, you were so close. Now I do have a question up here. Let's see. If your retirement date is, say, 6 months after your separation date, you lose any sick leave conversion. Yes. So if you spend any time as a deferred member, even if it's 1 day as a deferred member, then you lose all your sick leave. So that's why I spend all that time stressing how the exact method for going straight from active work into retirement. So if you defer your retirement for any amount of time, then you just lose all your sick leave. And that's just your employer's rule for that. Okay, so now that we know that the date And this should say actually the date to submit the form for the Ready to Retire counseling session, because we're not having a call in anymore. We know that that date is 6 months before your projected retirement date. You can just take your projected retirement date, subtract 6 months, write that date in. Okay. And the question is, when will the new form include the option election be available? It may be, let's see. So today is November 4th. It's a Thursday. It may be as soon as mid next week, late next week. Could be the following week, but I would guess it's going to be in the next 2 weeks that we're going to launch that new form. Oh, and you have a counseling session scheduled for January 4th. So yeah, you're probably going to be using the new form. And then does that include PTO for Alameda Health System employees? Interesting question that I have never gotten. The question is, if you are an Alameda Health System employee and you become a deferred member, do you lose some part of your PTO because all the sick leave and the vacation is all in one PTO bucket? My guess, here's my guess. I think Alameda Health System cashes you out for all of the PTO. Oh, and okay, here's another point with Alameda Health System. Because you don't have a big bucket of discrete sick leave, there's not a lot of sick leave conversion that we do for you. The only sick leave conversion that we do for you is in, let me see here. It's called extended sick leave or catastrophic sick leave or something like that. Let's see what happens to my unused sick leave. So if you're in Alameda Health System, yeah, unused PTO does not count towards service credit. So I think what's going to happen with the PTO is they cash you out for it. The only service credit you get would be for the extended sick leave. And you might still have some leave balances called intermittent sick leave. So that would be what we would convert. Okay. And to find that info, that's on you go to members, understanding your ACERA retirement benefits, earning and purchasing service credit, and then scroll down to where it says what happens to my unused sick leave. Okay. Are retirees allowed to participate in Alameda County deferred compensation? You can't, I don't think you can put any more money in deferred compensation because you're not being compensated by the county anymore. So there's no compensation to defer. But you will maintain, I mean, you can maintain your account. And in fact, most people do. And you just take periodic withdrawals from it. And the Gene Hilliard, who is the county's deferred compensation representative, is going to go through all of that in the post session that starts at noon. So it's going to go from noon to 12:45. Let me just double check that I've heard from him. Yep, and he'll be here. Okay. So he can answer all of those deferred compensation questions for you. He's the real expert on that. I'm not really an expert in that. Okay. Now, when can you expect your first retirement check? Well, within the 4 to 6 weeks after your last employer's paycheck. Now, if there's any major issues with your file, such as those listed here, it could be that we have to start you off on 80% payments until the issues are resolved, and then we'll get you up to 100% payments, and then you'll get retro payments for any less than 100% payments we did. But the vast majority of people these days, I think almost everyone these days gets on 100% payments right off the bat because we revamped our whole process so that we have all the documents we need in advance. We have all the info we need in advance, and we just get you on right on 100% payments. Okay, now here's the point in the presentation where I tell you about the 5 retirement allowance options. So this is when we were talking about the option election earlier, that is going to start happening on your retirement application. It's going to be the election among these 5 options. So at the time of retirement is your opportunity to choose one of these 5 options, and you can't change your selection later in retirement. So it's good to understand what these options are so that you know what you're choosing. I'm going to tell you for each option. So there's the unmodified option. There's 5 unmodified options 1 through 4. For each option, I'm going to show you a slide with a table. And this top row is going to talk about your retirement allowance as a retiree. And everything else below that is going to talk about what your beneficiaries are going to be eligible for after you die. Okay. So beginning with the first option, known as the unmodified option. This one pays the maximum retirement allowance of any of the 5 options. That's why the vast majority of people select the unmodified option, because it pays the most to you as the retiree while you're retired. Now, when you die, it will pay 60% monthly continuance. And remember, a continuance is a continuing monthly payment to a beneficiary. And let me just do another definition. A beneficiary just means somebody who gets benefits. And so your ACERA beneficiary is someone who gets your ACERA death benefits. Okay. So this pays a 60% monthly continuance to your ACERA beneficiary. Now, if your beneficiary is your spouse or state registered domestic partner, it's going to be a lifetime continuance. So they're going to get the continuance every month for the rest of their life. But you have to have married them or have registered them as a state registered domestic partner at least 1 year before retirement in order for them to get the continuance at all. The continuance is 60%. It's 60% of whatever your retirement allowance is at the time that you die. So whatever you were getting every month, they're going to get 60% of that every month for the rest of their life. If you have a service-connected disability retirement, it's not 60%, it's 100%. Okay. Now, if you don't have a spouse or state registered domestic partner, but you do have a minor child or minor children, they will get the continuance, but it's not going to be for the rest of their life. It's temporary. And it's going to stop at age 18. Or it could stop at age 22. So continue through age 18 to 22 if they are enrolled as a full-time student in an accredited school. But it will stop if they marry or register a state domestic partner in that time. Okay. It's going to stop. 22 is the max for that, though. It's going to stop at 22 regardless. Okay. Another scenario is you don't have a spouse or state registered domestic partner or minor children, but you still want to take the unmodified option. Perfect. Go ahead and do that. And you can even still name a beneficiary, but not for a continuance. The only people that you can name for a continuance under the unmodified option are these 3 people. You can name a beneficiary for a lump sum payment, okay? And what the beneficiary is going to get when you die, and the beneficiary can be anyone, is they're going to get basically a refund of the balance of your contribution account with ACERA. So it's going to be all of the contributions that you paid into your contribution account from your paycheck your entire career. Okay, all of those contributions plus all the interest we have posted to your account based on the interest that that money has earned based on our investments, minus all of the retirement allowance payments we've already paid out to you while you were a retiree. So the thing with this is we're actually going to pay you out. I mean, there's going to be no balance left in there after the first 3 to 5 years of retirement. So if you live more than 3 to 5 years, there's going to be no balance of your contribution account left to pay out in a lump sum to a beneficiary. So that's the bad news. The good news, that means that everything you paid into the retirement system throughout your entire career, we're going to give you back in your first 3 to 5 years of retirement. And then everything after that first 3 to 5 years is like pure bonus for you. If you live another 30 years, like pure bonus. Okay. That's the beauty of participating in a defined benefit pension plan, because your benefit is defined for the rest of your life. No matter what happens, you're going to get that monthly retirement allowance every month for the rest of your life. And it doesn't matter how much you contributed to the fund. Now, the reason that we're able to do that is because your employer made contributions, but mostly it's the interest that we've earned. That the interest pays for 75% of your lifetime retirement allowance on average. So that's it's an amazing thing to participate in a pension, but that's sort of a digression. So we're talking about the unmodified option. And so the bottom line is that if you have a spouse, domestic partner, minor child, at the time of retirement, you can name them for a continuance. If you don't, you can name a lump sum beneficiary, but that money is going to run out in 3 to 5 years. Okay, there's a third scenario. You have a spouse, say registered domestic partner or minor children, that you name for a continuance at the time of retirement, but they die before you do while you're a retiree. Okay, now if that happens, you can name a new beneficiary, but not for a continuance. You can only name a new lump sum beneficiary in retirement. The only opportunity to name beneficiaries for a continuance is at the time of retirement. And that is the same, that goes for if you don't have a spouse at the time you retire, but then in retirement, you meet the love of your life and you get married, you can name them only for lump sum benefit payments, not for a continuance. Okay, that's just the way the rules work at Acera. Okay, so that's all I want to say on the unmodified option. Let me check the questions here. There's a question, when are you going to do this again? What do you mean by this? Do you mean have another pre-retirement seminar? We're going to have one in January, but we're also going to post this video out on our website within the next week. So you can rewatch it then, if that's what you mean. Let me know if that's not what you mean. Okay. Okay. Yep. That is what you meant. Yep. We're going to do it in January, but yeah, we'll post the full video out there in a week. And so you can just rewatch it, or there's actually already a video up from August of this whole thing. So you could, watch it right after this session if you like. And then there's a question, if you're currently going through a divorce and both of you agree to leave each other's retirement alone, does the divorce decree have to say that? Yes, it does. Absolutely. Well, let me reel that back in. The divorce decree, like the judgment, I'm not sure if it says it on that document, but I think it says it on as the domestic relations order that you get along with the judgment. So if you want more information on that, I recommend going to our page on divorce, acera.org/divorce. And there's actually a sample domestic relations order on there. And then there's more information about how divorce affects your Acera benefits on that page. And then we do offer some like limited, if you want to call in and ask one of our attorneys questions about how divorce affects your Acera benefits, you can do that. We can't give you like legal advice on like negotiating your divorce, but we do want you to understand how divorce affects your Acera benefits before you go through that. So yeah, I recommend starting out on that page, acera.org/divorce. Okay, moving along. The next option, option number 1. This is the only one of the 5 options that never pays a continuance to anyone ever. What this does is kind of 2 things. The first is that it pays basically the same as the unmodified option, but a little bit less. Okay, no other options are going to pay as much as the unmodified option. But the option number 1 pays almost as much as the unmodified option, just slightly less. The other thing that this does is it allows you to name a lump sum beneficiary for a lump sum death benefit and extends that time that there's going to be a balance on your account from 3 to 5 years to 10 to 12 years there's some different accounting that they use to make that happen. So if you were to die within the first 10 to 12 years, there would be a lump sum in your contribution account left for your lump sum beneficiary. Option number 2 does a few things here. The first thing that it does is that, of course, it's going to pay less than the unmodified option. Okay. But what it does, the main thing that it does is, excuse me, rather than paying 60% continuance to a beneficiary, it pays 100% continuance. So whatever your retirement allowance was at the time that you died, that's what your beneficiary is going to get for the rest of their life. Okay, the second thing that this does is it allows you to name anyone as a beneficiary. So it doesn't have to be just spouse, state registered domestic partner. Now, if you do have a spouse or state registered domestic partner, their right to that continuance will supersede anyone you designate. Okay, now there's the part about what you get as a retiree. It says it's less than the unmodified option, of course, but how much less? Well, the reduction from what the unmodified option pays is going to be based on the life expectancy of whoever you name as your continuance beneficiary. Because if the person's significantly younger than you, they have a longer lifespan, projected lifespan, we figure we're going to have to pay them more. So we're going to pay you less while you're a retiree. And that amount is calculated at the time of your retirement, that reduction. And if your beneficiary dies before you do, we don't recalculate it. And again, you can't name a new beneficiary for a continuance just for a lump sum. Okay. So this is all calculated in at the time of your retirement, and whatever your retirement allowance is calculated to be at the time of retirement, that's what it's going to be for the rest of your life, plus cost of living adjustments. Okay, let me see. I have a question up here. Okay, it's basically a question about like your wife is currently listed as a beneficiary. Now that is, she's listed as a beneficiary for your active death benefits. So should you die before retirement, there are death benefits that she would get based on that. Now, what's going to happen is at the time of retirement, you are going to fill out the retirement application, and then you'll name her as the continuance beneficiary on that application, and then that will take care of that. So she'll just be your beneficiary for the continuance payment. Okay, so you don't have to worry about getting that wrong. Okay, option number 3 is the exact same as option 2 with one difference. Oh, you're welcome. The difference is how much it pays to the beneficiary. So rather than it paying 100% continuance to the beneficiary, it's only going to pay 50%. Now, because we're going to be paying the beneficiary less, we're actually going to pay you more as a retiree. So this pays less than the unmodified option, but more than option 2. And then everything else about option 3 is the same as option 2. Option 4 is very much the same as options 2 and 3. You can name anyone as a beneficiary for a continuance. It's just that you can name more than one person as a beneficiary for a continuance. So you could name 2 people or 3 people, and your beneficiaries could be anyone. The other thing that you can do is, rather than name multiple people for a continuance, you could name one person for a continuance and specify a lower percentage. So you don't have to pick 50% or 100%. You could do like 20%. Okay. Now there's so many different iterations of this that when the online benefit estimator doesn't give you an estimate for option 4, if you want an estimate for that, you have to fill out our estimate request form. But you do have a lot of options with option 4. And then, but all the same rules for option 4 are the same as options 2 and 3. And how much less than the unmodified option this pays is based on the life expectancy of the youngest beneficiary. Okay, so those are the 5 retirement options. Now, to get an estimate for what exactly these, like a projection, I mean, I say exactly, but let's call it a precision estimate. So here are some screenshots from the benefit estimator. And the question is, can we see the slides after this? And they're actually already posted out on the retirement planning seminars page. If you want to go check that out, there's a PDF of all the slides. So to get an estimate of the options, this is a screenshot again of the benefit estimator in your account on our website. So you do your retirement scenario here with your dates, hit calculate, you get the projected service credit and salary. Now what you do here is you make sure that this information is right for whoever you want to leave a continuance benefit for. If you select a beneficiary from the drop down here, you might actually find that your beneficiary is already listed in there, and so you can just select them. Now, if you do that, I want you to make sure that the date of birth is correct, because some of them are incorrect and that will throw off the calculations. So you can just type the correct date of birth in, and then you hit get estimate. You end up with the PDF estimate here. And now it makes a little more sense now that I've told you about the options. So zooming in, you can see that it gives you an estimate for the unmodified option and options 1 through 3. And it also gives you an estimate for your beneficiary's allowance after you pass away. And it gives you 2 more numbers here for option 1, because option 1 doesn't have, like I said, a continuance, but it does give you some other numbers to work with to help you plan your retirement. It tells you basically the balance of your contribution account, and then it tells you how much is going to come out of that balance every month in your retirement payment. So if you want to figure out how long that balance is going to last, you can basically take the big number and divide it by the little number, and it tells you how many months it's going to last. And you can divide it by 12 again, and it'll tell you how many years it's going to last. Like I said, it should last 10 to 12 years. Okay, so we have a half hour left, which is just enough time to talk about the other benefits, which is our last big topic that we have. The other couple of topics are kind of short. So when we're talking about other benefits, we're talking about a few different things. Basically, what we're focusing on here are these non-guaranteed benefits. So at some point in the past, the county decided that the retirees from the county needed extra help in terms of healthcare money in retirement. And so they started a reserve fund called the Supplemental Retiree Benefits Reserve to help pay for the costs associated with healthcare. So what Acera does is we offer different healthcare options, different healthcare subsidies that are paid out of that reserve fund to help eligible members pay for healthcare and other stuff in retirement. So here is the list of non-guaranteed benefits. These are determined by the Board of Retirement. So they're the ones that are in charge of that reserve fund, and they determine what the benefits are and what the levels of benefits are, because their whole goal is to ensure the sustainability of that fund. So they can like change what the benefits are, reduce them, or eliminate them in order to make sure that there's money in the fund to pay for these type of benefits. Currently, there's $1 billion in this fund. So this fund is not hurting for money. Okay. So it's considered very sustainable currently. And before I dive in there, I have one question on the last topic. Why is it 10 to 12 years of lasting relevant if it's a lifetime retirement benefit? Okay, so this is a question about option number 1. If you recall, the main part of what we're talking about when we're talking about those 5 retirement options is what your beneficiaries are going to get. For you, it's easy. You're going to get a lifetime retirement. So don't get that confused, because under all 5 options, your retirement allowance is for the rest of your life. So when you get this retirement allowance projection, this estimate, and you're looking at these numbers in this column, this is a lifetime allowance. Okay. So don't get confused about that. Your retirement is for the rest of your life, every month for the rest of your life. Now, when we're talking about beneficiaries, there's different rules set forth in the state law about what beneficiaries are eligible for, and you do have some ability to select different options among the different options to provide different things for your beneficiaries. For the majority of the options, the unmodified option and options 2 through 4, you can name a continuance to a beneficiary, And in most cases, it's a lifetime continuance to an eligible beneficiary. Now there are some, now for option one is special. There you can't name it. What it does is if you don't have somebody you want to name a lifetime continuance to, if you don't have somebody you want to name for a lifetime continuance, but you do have somebody you might potentially want to leave a big lump sum to, that's why you would choose option one. And so, like I said, it pays almost as much as the unmodified option. Like in this example that I ran, let's see, it's about $9 less than the unmodified option. So, so it's just an extra option, option one, that doesn't have a continuous connected with it, but it does leave a longer period where there's a lump sum left for a lump sum beneficiary. So it's just an additional option for you. Okay, so let's talk about each one of these benefits. This chart is a summary of all the benefits. You can see that there are 4 healthcare subsidies here: medical subsidy, dental subsidy, vision subsidy, Medicare subsidy. And then there is a supplemental cost of living adjustment, which is not considered a healthcare subsidy. And then there are different levels of qualification. For the supplemental cost of living adjustment, you don't need any years of ACERA service credit to qualify. Everyone is eligible for that. And I'll talk about when that kicks in a little bit later. But for all of the other subsidies, you need to have at least 10 years of ACERA service credit. And I say ACERA service credit because I mean that reciprocal service credit doesn't count if you have reciprocity with another retirement system. Okay, so then for the medical subsidy, there are even different levels if you reach 15 or 20 years of service credit. So let me talk about, this is just the overview. Let me talk about each one of these in detail. We'll talk about the medical benefits first. Okay. And let me see, I have a question here. Let me check this out. Okay, so it's a question about continuing life insurance into retirement. ACERA does not offer any life insurance options. So if you have questions about continuing life insurance into retirement, that would be something that you would want to direct toward the Employee Benefit Center if you're a county employee, or to probably your human resources department for the other employers. Okay, so we'll talk about medical first. Monthly medical allowance is what MMA stands for. The monthly medical allowance is a non-guaranteed benefit. All of these 5 benefits that I outlined are non-guaranteed benefits. We like to emphasize that because they're available based on whether there's money in that reserve fund or not. Now, like I said, the board of retirement, their whole goal is keeping that fund sustainable. So, you know, that's how they kind of negotiate that. But it is a non-guaranteed benefit. It's just an extra benefit that is based on there being money in that reserve fund. Now, the monthly medical allowance is here. What it does is it offset costs of being enrolled in a ACERA-sponsored medical plan. So it doesn't work with outside plans. You can go off and get your own medical plan if you want, but you can't use the monthly medical allowance for it. Now, for our group plan options, it pays for, it helps offset the cost of the monthly premiums. For our individual plan options, not only does it help offset the cost for the premiums, but also copays and deductibles if there are any. The amount of the monthly medical allowance is set annually by the Board of Retirement. That's in the summertime, in June, I think. And then you, the retiree, are responsible for any costs exceeding the amount of the monthly medical allowance. And the monthly medical allowance only helps cover your costs, not your beneficiaries, survivors, former spouses, dependents, anyone else, but you can enroll them in the coverage. It's just that the subsidy doesn't cover them. Now, here's the subsidy amount. For 2021, and actually, we do have new subsidy amounts for 2022. These all went up. So sorry I did not post that yet. If you go to acera.org/MMA, you'll see all of the new amounts. Okay. So you can see that the amount for 2021 for the full is $578.65. I think it went up to like maybe $596 or thereabouts. Let me just why don't we just take a peek over there real fast? I can show you what they are since I didn't update the slides. So it's $596.73 for 2022. And then the 15, if you have at least 15 years of ASERA, so that's the 20-year, if you have at least 20 years of ASERA service. If you have at least 15 years of ASERA service, the amount is going to be $447.55. And then if you have at least 10 years of ASERA service, it's $298.37. Okay. So going back to the presentation, our open enrollment is November of every year. We're currently in our open enrollment for our retirees. That's your annual choice opportunity to select among the plans. But at the time of retirement, that is also a qualifying event, and you can just get right into one of these plans. So you can select one of them at the time of retirement. Now there's two kind of groups of plans here. There's our ones for people who are not Medicare eligible. So they're 65 and not, they're under 65. And then there's Medicare eligible people. So that's when you're 65 and older. So you would select from these plans. And you can see there are three companies here: Kaiser Permanente, United Healthcare, and then there are individual plans through Via Benefits. Now, what I'm going to do is I'm going to talk about the group plans first. So I'm going to talk about the Kaiser and United Healthcare plans for the non-Medicare eligible people. Then I'll talk about the Kaiser plan for the Medicare eligible people. And then I'll talk about the individual plans through Via Benefits all at one time. It just makes more logical sense to do it that way. The full plan details for all of these are in our retiree enrollment guide. And actually, we've already published our 2022 guide. So if you go to acera.org/guide, you'll see the 2022 guide out there. Okay. And then there's a question: after we retire, is it possible that the non-guaranteed benefit is still going to change if the board of retirement decides differently? Absolutely. They look at it every single year. Every single year we have an actuary measure how sustainable they think the fund is, and the board of retirement decides whether to make little adjustments, sometimes occasionally major adjustments, not very often, to what the benefits are. So the amounts change every year, or can change every year. These medical plan costs change every year. So if you're not going to retire in the next year, then all of these amounts, might look a little bit different when it comes time for you to retire. And there's another question: if you're planning to retire within a month or two of hitting 65, should you just wait until 65 to get Medicare? It sounds like you're going to turn 65 and then retire a couple of months after that. And so, yeah, you should definitely wait to get Medicare for when you're retired. You may be able to start applying early. I'm not an expert in Medicare, but for transitioning into Medicare, I highly recommend doing our Medicare transition seminar. You can sign up for that on our website. We offer it 6 times a year, every 2 months. And if you're almost about to turn 65, maybe like 3 months before turning 65, go ahead and do that seminar. It only lasts about maybe an hour and 15 minutes or so. And it's everything you need to know about transitioning into Medicare. Or you could just watch the video that we have posted on our site, because we record them. Okay, so these are the non-Medicare plan group costs. So you can see that, and again, these are the 2021 premiums. They went up. All of these went up a little bit for 2022. So you can find those new premiums out in that retiree enrollment guide, acera.org/guide. But kind of the bottom line here is that the cheapest one is still going to be the United Healthcare Signature Value Advantage HMO. And the other bottom line that I want to tell you about is that even the 20-year monthly medical allowance doesn't cover the full cost of being enrolled in these plans. You're going to owe another, almost $200, or maybe like $170 in some cases if you take the Signature Value Advantage HMO. So the monthly medical allowance just helps cover the cost for these, what we call early retiree plans, which are non-Medicare plans. And then the way that it works regarding the monthly medical allowance, if you're eligible for it, is, and this is like a really crude illustration of your Acera check stub that you're going to get electronically when you retire is you have your gross pay, right? So let's say your gross retirement allowance is $4,000. Now in the deductions column, you're gonna, if you enroll in one of our group plans, you'll see the dollar amount for that group plan come out in the deductions column. In the additions column, you'll see the monthly medical allowance go back in, that you're, whichever one you're eligible for, if you're eligible for it. And and so your net pay is what you end up with after you kind of pay the difference between the premium and what the monthly medical allowance covers. And then also there's going to be taxes taken out of this because you're going to go and owe income taxes. Okay. So, but that's kind of how the monthly medical allowance works regarding, you know, how we pay it to you if you're eligible for it, if you're in one of the group plans. Now then, for the Medicare group plan, there's one option. It's the Kaiser Permanente Senior Advantage plan. And for all of these group plans, you have to live in the service areas in California. So it's the service areas, they're posted out on our website, but they're basically the Bay Area, Sacramento area, Fresno area, Southern California. And for Kaiser, they also have Santa Cruz. So if you live outside those areas, you can't enroll in the group plans, but then there's individual plan options for you. Okay, but since we're talking about the Kaiser Permanente Senior Advantage plan, I just wanted to show you that the premiums are a lot cheaper. And in fact, they went down, which doesn't often happen, but it actually has happened with this plan for the last 2 years. So it's actually going to be cheaper than 382.21. And you can find those new amounts in our guide at acera.org/guide. But what I'm kind of doing with this slide is showing you that there's a bunch of different scenarios for the premiums if you're enrolling your family, and whether you're the one who's Medicare eligible or whether it's your spouse who's Medicare eligible. So there's different combinations, and then there's going to be different monthly medical allowance combinations. And so this is actually all calculated out in that guide for you. This is kind of like a reproduction of what's in the guide. But one thing that I want to point out here is that the monthly medical allowance here matches the premium amount. And that is because the monthly medical allowance never pays more than the premium amount. So if your premium amount is less than the monthly medical allowance you're eligible for, you don't get to keep the change. So your monthly medical allowance becomes the exact amount of the premium, and your out-of-pocket cost is basically zero. Okay, so that's how that works for that plan. Okay, good question. What does medical look like if you decide to leave California after you retire? That brings us to this topic about individual plans through VIA benefits. So who can enroll in individual plans through VIA benefits? You can enroll in an individual plan if you're not yet Medicare eligible, as long as you live outside our group plan service areas that I just listed out. So if you move outside California, or you move like up to Northern California, like way up north, up to Redding, that's outside the group plan service area. And so then that you can enroll in an individual plan. And this is, but only in the USA. Now for Medicare eligible people, it doesn't matter if you live in the Kaiser group plan service area or not. You can live anywhere in the US and you can enroll in an individual plan through VIA benefits, as long as you first enroll in Medicare Parts A and B. Now, what is VIA benefits? VIA benefits is a private insurance carrier that we contract with, and they contract with a whole bunch of different insurance carriers, at least 80 of them. And what they do is they facilitate your enrollment in those individual plans with those insurance carriers. And so it's kind of like a central marketplace for you to find a plan, and they help you find a plan. That's what we pay them for contractually, is to help you find a plan. So their individual plans, like I said, it's anywhere in the US, there are plans available. The enrollment is over the telephone or online. The telephone is actually pretty good because if you call in, you'll talk to a certified, salaried, non-commissioned, non-biased benefit advisor. And I say all that to say that they don't care, they don't receive a commission based on certain insurance companies. They're just paid a salary. So they're just going to help you find the plan that's right for you. And when you call them, you tell them where you live or where you're going to move to, how much you want to spend, what level of coverage you want to get. You can even go down to like get as granular as what doctors you want to visit, what prescription drugs you need, and they will help you find a plan. They have 1,000 plans and they'll narrow them all down for you, and you can choose among those. And the monthly medical allowance, again, for these plans, pays for not only premiums but deductibles and copays if you happen to choose a deductible plan. Okay, one thing that I want to explain about this is how if you're eligible for the monthly medical allowance, it works a little bit differently with the via benefits plans. Hang on one second. Okay, it works a little bit differently. So we can't put it in your retirement check because it's a little bit complicated. So what we do instead is we contract with Via Benefits to administer your monthly medical allowance for you. So the way this works is that if you're eligible for the monthly medical allowance, in this yet another crude illustration, Sarah is taking your monthly medical allowance and sending it over to Via Benefits. Via Benefits is going to open a health reimbursement account for you. That's where your monthly medical allowance is going to reside. Okay. Now here's you, and here's your bank account. You are going to enroll in medical coverage through Via Benefits, through an individual insurance company, and that insurance company is going to charge you a monthly premium for being enrolled in that plan. So you're going to pay that insurance company directly. Okay, now over here, once you're enrolled in insurance, you're going to go out to the doctor. Part of your visit will probably be covered, but you'll owe the doctor a copay. So you will also pay that directly. Now you're out some money in your bank account. So what you do is you submit a reimbursement claim back to Via Benefits, and they will pay you out of your health reimbursement account that monthly medical allowance money that is there waiting for you. Okay, so that's how that works. You can set up a lot of the stuff to happen automatically, especially the recurring stuff. Like you can set up recurring payments to the insurance company automatically out of your bank account. So you don't have to think about it. And you can get reimbursed for that automatically. So you don't have to think about it. And then you would just have to submit individual reimbursements from doctor's visits to Via Benefits, but they have an app for that. And you can do that through your online account with them. So they try to make it easy for you. Excuse me. Okay, so I have a couple of questions. Can we change to Via Benefits at any time when our situation changes, or do we need to wait until open enrollment? Depends on how the situation is changing. You're probably referring to what is known as qualifying events. And if you have a qualifying event and it's like getting married, getting divorced, a spouse dies, child is born, you move more than 50 miles, or you move out of the group plan service area, there's different, and I'm not sure I'm getting all of them exactly correct. So you're going to want to check our webpage for what those exactly are. But yes, if you have one of those qualifying events, or like a spouse retires, there's different qualifying events. So at that point, you could change to Via Benefits, especially if you move. Like if you move out of the group plan service area, you can definitely change to Via Benefits at that time. Question, what if United Healthcare is in the state I live in? Would the monthly medical allowance apply? Yes, if you enroll in that United Healthcare plan through Via Benefits. So if you call it Via Benefits, you find a United Healthcare plan and enroll in it, then we can do this whole HRA monthly medical allowance thing for you. If you go out on your own and get a United Healthcare plan, then you're on your own. You can't use the monthly medical allowance. And so another question, does this also apply to FSA eligible costs that may not be covered by the insurance company? When you say, does this also apply, what exactly are you thinking about doing with the FSA, and where's the FSA going to come from? Because Acera does not offer an FSA. So it would have to be something maybe through like a spouse's employer. So let me know if you have follow-up details for that. Okay, now one thing that I want to talk about specifically about the Medicare plans and VA benefits. This is not the non-Medicare plans. This is only the Medicare plans and VA benefits. These plans are so inexpensive that the Board of Retirement decided that the monthly medical allowance amounts should be a little bit lower for those plans. So this is the set of monthly medical allowance amounts for 2021. They went up a little for 2022, and which again you can find on that monthly medical allowance page. Okay, so that is the medical. So we're probably going to go over time slightly, but we're going to talk about dental, vision, the Medicare subsidy, and the supplemental cost of living adjustment. And those won't take as long as the medical part. Okay, dental plans. So these are actually all the same costs. The dental and vision plans are all the same costs for 2022 because we negotiated a contract so that they don't increase. So the way this works is that if you have at least 10 years of ACERA service credit, when you retire, you have to enroll at least yourself in one of our dental plans, but it doesn't cost you anything. And so that's why in this column here, the self and the subsidy amount is the same. So for example, if you have at least 10 years of ACERA service credit and you enroll in the Delta Dental PPO, you would see $44.15 come out of your retirement check, and you would see $44.15 go back into your retirement check. And so you would end up paying $0. And for Delta Care USA, that's $22.18. Now you can enroll self plus one, you can enroll your family. They're not subsidized. No one else is subsidized with these benefits except for you, the retiree. If you have less than 10 years of ACERA service credit, you can still enroll in the plan, but it's a different set of premiums and you have to pay the whole cost. There's no subsidy. Same thing for vision. Now the subsidy amount for vision is $3.97 for the standard plan. If you want to, you can buy up into the VSP premium plan, also known as the buy-up plan. And we're talking about for people with 10 years or more of ACERA service credit. And what you end up paying is the difference between the subsidy doesn't go up. So you pay $14.26 out of your ACERA check, and $3.97 goes back in the subsidy. And again, if you have less than 10 years of ACERA service credit, you can enroll voluntarily, and these are your set of premiums here. Okay. So before I move on to the Medicare Part B, let's see, I have a follow-up to that earlier question. I see. I gotcha. So by FSA, you were saying HRA. Yeah, sorry, I was confused. So no, you can't use it for extra stuff. The monthly medical allowance, the rules the board has set up is that the monthly medical allowance is only for those individual plans. It only covers the monthly premium, any deductibles that you have, and then co-pays. So if your plan happens to cover acupuncture, I don't necessarily know that health insurance plans do cover this. And so you went out for a visit and had a copay, then you could submit that copay for your reimbursement, I believe. I think you would probably want to write into us before you did that to just verify that, but it could probably work that way. But if you're going outside for acupuncture, which you normally would, with an FSA, you could submit reimbursement claims for that. You can't do that with the HRA. So the HRA is a lot different than the FSA that you do when you're employed. Okay. So the fourth non-guaranteed benefit I'll talk about is the Medicare Part B reimbursement plan. What happens is when you become Medicare eligible at age 65, you are going to, and you want to receive Medicare, you're going to need to enroll in Medicare. So you're going to enroll in Medicare Part A, which is hospitalization coverage, Medicare Part B, which is doctor's visits. And then depending on your plan, you might enroll in Medicare Part D, which is prescription drugs. So for Medicare Part A, if you have worked at least 10 years and paid into Medicare at least 10 years, then Part A is going to be free for you. For those safety members who haven't done that, you can still enroll in Medicare. It's just that you'll need to pay for Medicare Part A. There will be a cost, but everyone can enroll in Medicare who's over age 65, even if you didn't pay in. Now, for Medicare Part B, there's a cost for everyone. So once you enroll in that, Social Security Administration is going to start charging you a monthly cost for being enrolled in Medicare Part B. Now, what the Board of Retirement has done is they have created this Medicare Part B reimbursement plan to help you pay for that. What they do is they set a reimbursement at the lowest level that anyone in Medicare Part B, any of our retirees pay for Medicare Part B, which happens to be $148.50 for 2021. And so you would just, once you enroll in this by submitting an enrollment form and proving that you're enrolled in Medicare Part B, we're just going to start paying $148.50 into your retirement check. Okay. So that's $150 basically that you don't want to miss out on. So once you're Medicare eligible and you enroll in Medicare Part B, go ahead and enroll in this plan. Don't forget to do it. And this is this is one of those benefits that is only available if you have at least 10 years of a SARE service credit or a service-connected disability retirement. All of those benefits that I was showing you that require at least 10 years of service credit. Alternatively, you can have a service-connected disability retirement and have less than 10 years and qualify. And one more thing that I want to point out is that for those safety members who are going to enroll in Medicare and they want to access the Kaiser Permanente Senior Advantage Group Plan through Acera, I don't think you actually need to enroll in Medicare Part A. There's an option for not enrolling in Medicare Part A and only enrolling in Medicare Part B. So that's something to consider. And then there's a question, can we enroll in the FSA during open enrollment? If by FSA you're talking about that health reimbursement account for VIA benefits, it's not something you enroll in. It's something that automatically is generated for you if you choose a plan through VIA benefits and you are eligible for the monthly medical allowance. So you don't have to do anything. We just set it up for you automatically. And then there's a question, how does it work if you select Kaiser Senior Advantage? Do you still enroll in Medicare Parts A and B? Yes. So any of those plans, those Medicare plans, they're known as Medicare Advantage plans. There's other plans called Medigap plans. They all work with Medicare. So you enroll in Medicare first. Medicare provides most of the coverage, but then these plans kind of provide a higher level of coverage. They kind of fill in some of the gaps that Medicare doesn't cover. So they provide a higher level of coverage than Medicare alone. So you could just go with regular old Medicare, but if you want to have a higher level of coverage, especially if you have at least 15 years of a SARA service credit, enrolling in one of these Medicare plans like the Kaiser Permanente Senior Advantage basically costs you $0. So it's a good idea to go ahead and enroll in one of them. And then if you're paying at the lowest level, it's based on this Medicare Part B cost that Social Security is going to charge you is based on income levels. And if you're paying at the lowest level, then you're paying them $148.50. Well, if you enroll in this plan, you get $148.50 back in your Acera check. So Medicare Part B costs you $0, basically. Okay, so it's a pretty good deal. We offer a higher level of any of these non-guaranteed healthcare benefits than any county in California. So if you have that at least 10 years of Acera service credit, it's a really, really nice thing. Okay, finally, the final non-guaranteed benefit is the supplemental cost of living adjustment. Now, don't get this confused with the other cost of living adjustment. That one's vested, that one's guaranteed. The supplemental cost of living adjustment is extra. It gets paid on top of the vested cost of living adjustment. And it does that whenever you lose more than 15% of your buying power to inflation in retirement. And what this does is if that happens, it kicks in and it keeps you at 85% of your original buying power. So you can't. So if you think about inflation, prices keep getting inflated, but if you're on an income that doesn't keep up with inflation, that means over time you're losing your buying power. So what the supplemental cost of living adjustment does is makes sure that you don't lose more than 15% of your buying power to inflation. So this is a really powerful benefit, and everyone is eligible for this, even if you have less than 10 years of a SARA service credit. Okay, so moving on, our last two things, we basically have two more things to check off, and this one is just one slide. So I'm getting ready to turn it over to Jean Hilliard for our deferred compensation presentation in just a couple of minutes, but let me just go through this slide real quick. The reason I'm not touching on any of these in much detail, these life events, is because they don't necessarily apply to everyone. So what I'm doing is giving you links out to our website to learn more about these life events. So if you're going to defer your retirement, which we've talked a little bit about, which is quitting before retirement, go ahead and check out our deferred retirement page on that, because there's some information you're going to want to know about that. Also, if you're curious about death benefits, should you die before you retire, you can read about those on our death benefits page. Okay. If you are going to get divorced, or you're already divorced, or you're going to dissolve your domestic partnership, or it's already dissolved, you're definitely going to want to go ahead and read our divorce page at acera.org/divorce. If you are dealing with a disability, whether that is connected to your work or not, and you may have to retire early on a disability retirement, and you're wanting more information about that, go ahead and check out our disability retirement section of our website. There's a lot of information there, and disability retirement is an option that you have to retire early on a disability retirement if you can't, keep working. If you're going to work after retirement, somebody asked me about this earlier. There are some durations, limits, and restrictions. So go ahead and check out our Working After Retirement page. If you're going to relocate after retirement, please change your address with us by filling out our address change form. This helps us send you official notices that we need to send you from time to time. This helps us send you our annual report. And most importantly, it helps us send you our open enrollment packet every October that has all of the changes for the healthcare plans. Now, let me answer this one last question before I talk about this. How are taxes deducted from the monthly retirement payment? Oh, that does remind me of one more thing that I wanted to mention. Okay, yes, you're going to have to pay taxes on your retirement check because you contributed to the fund on a pre-tax basis. So you're going to need to pay income taxes on disbursements from the fund. You will fill out at the time of retirement a withholding election form so that we can calculate your withholding and withhold taxes for you. You can change that at any time if you need to adjust it. So it's very similar to how you fill out withholding during your active work. But yeah, you will owe income taxes on that. And one more thing I wanted to point out is all of those medical subsidies, healthcare subsidies that I was talking about, none of those are considered income for the purposes of taxation. So those are not taxable income. And then there's a question already forming up for Jean Hilliard. Can you talk briefly about required maximum distribution? You may mean required minimum distribution. And Jean is going to go into all of that shortly when I turn it over to him for the deferred compensation presentation. So one last thing, we recommend you sign up for ACERA email news. Occasionally there's something important we need to tell you about, and we don't email you unless you sign up for this. You go to acera.org/subscribe. We hardly send out any email, maybe like a couple of times a year. Okay, so you're not going to get inundated. So I recommend it. If you ever have more questions, there's a contact form on our website, acera.org/contact. You can email us, or you can call us at any time, 510-628-3000. We have a call center set up just for you and to answer all your questions. So, on behalf of the Acera Board of Retirement and Acera staff, we wish you a beautiful retirement. So, thanks for joining me.